Okay, so we're beginning our reading on what is referred to as market-based valuation as opposed to intrinsic value, where we discount cash flows. What we do is we look in the marketplace for prices and we value assets based on what other prices in the market are selling at, which is why it's called market-based valuation. And we're going to use price multiples and enterprise value multiples. And price multiples, we go through quite a few of them, price to earnings, price to book, price to sales. And this chapter is long. It's about 80 pages long, but there's a lot of it that's just repeat. So I'm going to hopefully try to tighten that up a bit. The PE is the longest part, so I'm going to take some time on the PE. But price to book, price to sales, I'll go very quickly over because a lot of it applies from PE, carries over to those two. So after we get past the PE, the rest of the chapter kind of flows nicely because we've done all the groundwork there is to do. So before I begin, let me say a word about the learning objectives. It's hard, as you know, I try to do every learning objective as a standalone learning objective. This chapter can't be done that way because I would have to do each learning objective for each of the 5 market-based valuations that we're doing, and that's just a lot of repetition. So instead I'm going to take a different approach. Rather than go through all of the learning objectives for all 5, I'm going to go through all 5 market-based valuations and just clump all the learning objectives together. So it's not going to break out as nicely as possible, but where I can break out the learning objectives, I will, so that you can see sort of where they're siloed. So let's start with the first one, comparables versus forecasted fundamentals. So comparables, we've seen comparables before, is where we say, look, those companies over there are trading at this multiple, so this company over here, because it's the same as those, should trade at the same multiple. So it's based on a multiple of similar assets, and we call those comparables, comps, guideline assets, or guideline companies. When we do this, we're looking at a relative valuation. Go back to level 1. Remember the difference between an absolute valuation, which is your discounted cash flow. You're looking at the company in isolation and coming up with a value. Comparables, the rationale behind that is you cannot price something in isolation. Everything is priced always relative to something else. So if I say to you, this steak is $12, is that expensive or cheap? Well, I don't know. How much is pork? Pork is $11. Well, the steak is cheap. Well, pork is $2. Well, the steak is expensive. Do you see the difference? So $12 on its own doesn't make a lot of sense until you put it in context relative to what else your money can buy. So that's why we look at, we call this a relative valuation. So if you take 2 companies and you decide that one of them has a lower PE than another, all you can say is that compared to each other, one of them has a relative overvaluation, they're relatively fairly valued, or a relative undervaluation. And this will be versus a closely matched stock, for example, or an average value of a stock's peer group. The economic rationale behind this, and it's flimsy, I'll agree on that one right off, is called the law of one price. And the law of one price is, look, 2 identical assets should sell for the same price. Well, now that works well if we're talking about 100 ounces of gold in New York versus 100 ounces of gold in London. Yes, they're similar assets, they should sell at the same price. But let's take the Canadian banks. You got 5 Canadian banks, 5 major serious Canadian banks, plus CIBC. So you could argue that, well, they're all Canadian, they're all the same. They should all sell at the same price. Not the same price per share, but the same multiple. But they don't. And they should all have the same kind of yield, but they don't. And here's why. They're not all similar. They're in the similar line of business. They do similar business, but they do not operate similarly. So this law of one price, while that kind of is nice and appealing and it makes sense and you get lured in if you think about it, no two companies are identical assets. So that brings up the idea that, well, hang on a second. If there's a peer group with a certain multiple, and I have one company that always has shone above the peer group, can I not adjust upwards? Yes, you can. You can make adjustments. All we're looking at here is some benchmark multiple that we can sort of value our company against. It may justify a premium to that benchmark multiple. It may justify a discount. We're going to get into that with each of the price multiples. So let's look at an example of what we mean by comparables. I think everybody knows what they are, but let's just make sure we got it straight. So let's say company A has earnings per share of $1.50 and it's selling for $37.50. We've identified a closely matched stock. Company B has a PE of 22. So we can approach this in one of two ways. We can say the price of A, the intrinsic value, or the price of A, the fair price of A, should be its EPS times whatever the multiple on the comparable is, times 22, or $33. It's selling at $37.50. So at this point, we could say, well, this appears to be relatively overvalued. We can't say it's overvalued. We can only say it's relatively overvalued by $37.50 minus 33. So we can say that. The other approach that we can take is we can look at the PE of A. And we can say, well, okay, it's selling at $37.50. It has earnings per share of $1.50. It has a PE of 25 versus 22. So we can take the PE of the other company times the earnings per share to come up with a comparable price and compare it with the current price, or we can take the current PE and compare it with the comparables PE. Here we have 25 and 22, so we can say the same thing again, that it appears to be relatively overvalued. But this time our overvaluation is in terms of 25 minus 22 times $1.50. Here we can go right to, hey, it's overvalued by $4.50. Here we have to say it's overvalued by a multiple of 3 times whatever EPS we have, $1.50. We get to the same $4.50. All right, let's look at forecasted fundamentals and the use of that. When we're doing this approach, we're arriving at some intrinsic value per share or some value for the firm, some enterprise value. So we'll come up with the V0 or the value of the firm. And this is arrived at by some discounted cash flow model. We've already seen dividend discount model. We've seen free cash flow to equity, free cash flow to the firm. We still have one more to get through, which is residual value, which is next. And we'll end up with some price that we can observe in the marketplace divided by X, or I put little x and big X, little x meaning a per share value of whatever the fundamental value is, the per share. Could be earnings per share, could be cash flow per share, could be book value per share, could be sales per share. But it's some fundamental value of the company, the price divided by that. And big X is a firm level measure, such as EBIT or EBITDA, or cash flow from operator, free cash flow to the firm, free cash flow to whatever the case is, as long as it's firm level, not per share. And the X, of course, is our fundamental forecasted value. So we have an observable that we can see. We can observe the price in the marketplace, and we can take whatever value we have to determine what the multiple is. We can also substitute the value that we get in our intrinsic model, V0, into this and divide it by the same fundamental value, and that would give us a justified multiple. So we could say, well, what is the PE that is justified by the fundamentals? Well, the fundamentals say this company should trade at 10 times earnings. Well, it's currently trading at 15. Well, then we can make a decision. Is it overvalued? So let's look at an example here. Let's say that we arrive at an intrinsic value of $10.20 and we forecast our earnings to be $1.20 out. What is the forward PE that is justified by these fundamentals? We will get $10.20 over 120 equals 8.5. This is just to show you, just to give you a rough idea in your head what we're talking about. The denominator is some fundamental value. That's all you really need to know, is it's some fundamental value. Here the fundamental value we're using is earnings. It doesn't have to be earnings. It could be anything. Our numerator can be the observed price we see in the marketplace or the intrinsic value we arrive at. The difference between an actual measured PE, whether on a trailing or a forward basis, versus a justified PE, and we'll get more into that as we go deeper into this chapter. So I've mentioned justified multiple a few times in the last learning objective. This one has us looking at it in more detail. So a justified multiple is an estimated fair value for that multiple. So let's look at the Gordon growth model that we saw 2 readings ago in the reading on dividend discount models, which is the simplest model to use. The intrinsic value of a stock can be expressed in terms of 3 variables: the dividend, the discount rate, and the growth rate. So if we let the price stand in for intrinsic value, we can express the Gordon growth model in this formulation. We divide both sides by next period's earnings, divide by E1. We get a forward PE over here. The price today divided by earnings 1 period out, that's a forward PE. We can see it can be expressed in terms of 3 variables: our R and our G, and of course our numerator here, D1 over E1, that's our dividend payout ratio. This is our earnings 1 period out, that's our dividends 1 period out. If you do the math on that, if you do the arithmetic on that, you'll get a dividend payout ratio. So there's a forward. To get a trailing, we just realize that, well, okay, let's bring the E1 to the E naught, the D1 to the D naught, and of course that's 1 plus G to get it back. And there's a trailing PE. So we can take a Gordon growth model and we can express the trailing and the forward PE algebraically and see what drives the justification for that PE. A higher dividend payout ratio, lower risk on the company, or higher earnings growth. However, once you get to a 2-stage and a 3-stage model or an H model, expressing the trailing and forward PE algebraically isn't going to work. So we need some other way to conceive of how do we get to a trailing and a forward PE. And I find that the model, even at the simplest form, the model just gets in the way. There's a much simpler way to do it, and I showed you back in the dividend discount model reading how to do it, and that's the approach we'll follow when we get to those problems. So let's just put that on the top shelf for now. To show you that you can use a justified multiple on any price multiple, and a price multiple is anything that has price in the numerator. Price to earnings, price to book, price to sales, price to cash flow. The price is a per share measure. As long as your denominator is a per share measure, you have a price multiple. Whatever price multiple you think makes sense for you. So let's just do an example of one here, justified multiple, based on price to book. And let's say that we look at a peer group and we come up with a price to book of 2.2 for the peer group. And we do a fundamental forecasting for the company. We arrive at a book value per share of $23 and an intrinsic value, or P0, that we think is justified, of $46. Now, this example, while it looks juvenile and simple, has an important point that if you get this point, you will understand the entire difference between pricing something out using forecasted fundamentals and why you would price something out using a comparable, and why it matters. Why you should do both. It's not a matter of I'm going to choose to do it this way or I'm going to choose to do it that way. You must do both. I cannot stress this enough. You have to do both. And I'll do a little Jerry Springer wrap up at the end to explain why. So let's look at the justified price to book based on the intrinsic value that we arrived at. Well, we know it's a price multiple, so what always goes in the numerator is our price, and book is in the denominator, which is 23. So we have a justified price to book based on the fundamentals of the company of 2. There we go. So it should be selling for a price to book of 2. We can look at the actual price in the market and determine whether or not it's fairly priced based on the justified multiple. Another way of arriving at a justified multiple is to say, well, you can't price things out in isolation. You have to price them out relative to other things. So rather than price it in isolation, I'm going to price it out relative to the peer group. So what am I trying to find here? I'm trying to find the numerator now. I'm trying to find price. So if price over book equals the multiple, then book times the multiple must equal the price. So 23 times 2.2 equals $50.60. So if we witness a stock, and let's say that it has a price in the marketplace, I'll just put P naught here, and let's say it has a price in the marketplace of $52. Intrinsically, at $46, we would say the stock appears to be overvalued in the marketplace. It's selling at 52 versus our 46. But when we price it out based on comparables, we get to 50/60, we would say it appears to be fairly valued. Here's the big deal. Here's why you need to do both. Let's say I give you a 12-ounce piece of meat and I say, price that out for me. And you say, well, it's nicely marbled. It's a New York strip. I can see it's cut from this part, this, that, the other thing. The weight comes in at this. It has this kind of texture. And you put a price of $12 on it. All right. Is that the right price? Should you sell it for $12? You don't know. So the fundamental value will give you a price today, but let's just say there's a shortage of steak out there, and suddenly steak is not $12 anymore. You look at what's being sold out there, and you see that pork, a substitute, is selling for $11. Suddenly, would you price that at $12 anymore? You would say, well, hang on a second. There should be, I should be multiplying pork by 1.5, which is $16.50, the multiple between pork and beef of 1.5. This $12 steak should be selling for $16.50. You go selling it for $12, you're leaving money on the table. Here's the reason why you do both, is because you may come up with an intrinsic value for a company, but if all the other companies are in such high demand, if the stocks for that particular sector are in such high demand, you have to take that into account. You can't just say, here's the price. You have to say, well, what's everything else priced at? And I have to price my asset pretty much at the same thing everything else is priced at. So think about selling your house in a particular neighborhood. What's the first thing the real estate agent brings you when you want to list your house? If you've ever sold a house, you'll know that he walks in, he sits down, he opens up a folder, and he'll give you the prices of the last 10 or 15 houses in your neighborhood that sold. Why? Because that's how you price your house. Sure, you could say, well, the lot should be worth this much because there's the school, here's the park, here's that. The foundation costs this much, the replacement value of the tiles, this, that, the other. You can build the price of your house that way fundamentally. But if the neighborhood doesn't support that price, you're not going to get it. The other thing is, if the neighborhood has decided to price it so much higher because of these intangibles that aren't in the fundamentals, you're going to miss that without the comparables. So when you price your house out, when the real estate agent sits down, he doesn't start measuring your floor space and feeling the texture of your carpet to say, oh, that's a good fiber count there, and what kind of paint did you use on the walls? Did you use the cheap paint or the expensive paint? He doesn't go through the house and fundamentally price it. He just says, look, here's the neighborhood. Here's what everything else sold at. You know, and this one has 3 bedrooms, that one has 3 bedrooms, this one has 4, you've got 4 with this and that, and they'll make some comparison between the closest 3 or 4 to yours, and then maybe adjust the price up or down for the extra room, maybe the swinging patio door, whatever the case is. Well, we do the same thing with companies. We look at a peer group, 2.2. And then we look at our company and we say, well, okay, but our company has better liquidity, better this, better that. Well, okay, we can justify something more than maybe a 2.2 perhaps. But you cannot price a company out in isolation. We get to $46. Great, 46. But what is everything else selling at? That's what you need to know. So if an industry is out of favor, don't fight that. If an industry is in huge demand, don't short it, right? So that's why you want to do both. I know I'm taking some time on this and I'm taking some pains on it, but that's the whole idea behind comparables. It's not an alternative. It's not like, well, maybe I'll price it out that way. You must price it out compared to the comparables. You must do it. It's not an option. Okay, let's move on. Okay, let's start with our first price multiple, which is price to earnings. You'll notice that there is no learning objective at the top of this page, is because there's about 8 to 10 learning objectives that apply not just to this multiple, but to the other 4 that we're doing as well. There were 5 that we're covering, the other 4 as well. So rather than do one learning objective for all 5 and then move on to the next learning objective for all 5, that can get confusing. I thought it better, well, let's just stick with one multiple all the way through, and then we'll cycle through the next multiple and the next one and the next one and the next one. So putting learning objectives down would just be a lot of confusing mess, so I'm just not going to do it unless it's relevant to just that one learning objective. Then I'll do it. Okay, so let's go. PE. This is the one we spend the most time on. Everything that we do in PE applies to any price multiple. So after we get through PE, you'll find price to book, price to sales. That goes fairly quickly. So what's the rationale behind using a price to earnings multiple? The biggest one is, hey, look, earnings power is the chief driver of investment value. The more the firm can earn, the more it should be worth, period. It is widely recognized and widely used. So you can communicate your ideas with other people very quickly through a PE. The drawbacks. Earnings per share can be 0, can be negative or very small versus the price in the marketplace. A PE will make no sense in that case. So let's take a stock that's selling at $10, earnings per share is 1 penny. Well, what kind of multiple is that? It would make no sense whatsoever to compare that price multiple with anything. If it's negative, you'll get a negative price, which means you must pay me to buy the stock. I'll buy 100 shares, but you got to pay me. That doesn't make any sense. The other problem is what to keep in the earnings per share number. What to keep, the recurring components, versus what to take out can be difficult to forecast and adjust for. And earnings per share is a highly managed number. You better be up on all your accounting policies, and you better be able to adjust earnings for differences in assumptions, in differences in accounting methods, differences in inventory valuation. Remember, FRA, we went through a lot of that stuff. Well, that's not gone. So in case you thought the PE was a simple thing, we're going to see that there are quite a few definitions of the price earnings multiple. Let's look at based on time period. Well, we have two. We have a trailing PE and a forward PE. The trailing PE is quite simple. It is quite simple. It is the most recent 4 quarters. Period. That's it. The most recent 4 quarters. We would use a trailing PE under 2 conditions. Number 1, if forecasts are just not possible. Or by logical elimination. Well, what I mean by that is, let's say that a company is about to restructure or acquire or divest. Well, a forward PE might be difficult to interpret because the business is changing so radically, in which case we would use a trailing PE because the trailing PE represents a most comparable number with other firms. You have to consider in the trailing PE potential dilution of earnings per share, transitory effects on earnings per share. So if you're looking at the last or the most recent 4 quarters, was there something in one of those quarters that is going to cause a bit of grief? Maybe it was a one-time event. Should we take it out? Was it a company-specific event? Is there cyclicality involved? In other words, are we at a different phase of the business cycle that would lead to the last, the PE, the trailing PE would lead to something that is not indicative of what the company is truly worth? Differences in accounting methods. And we're going to go through one. That's why I label them 1, 2, 3, 4. I'm going to go into more detail in each of these. The forward PE is next year's expected earnings. This is where we get into quite a few different variations of what the forward PE is. How do you measure next year's expected earnings? And you may think, well, it's next year's expected earnings. Well, we're going to see that there are 3 possible ways that you can measure next year's expected earnings. It's also called a leading PE or a prospective PE. The justification here is valuation is forward-looking, so it makes sense to use a forward PE. I'm buying the future, not the past. What do I need a trailing PE for? That's what you did. What you did should be in the price. I want to know what you're going to do, and I want to know if that's in the price, and if it's not, then I have some action that I can take. All right, let's go through those 4 points that I mentioned on the previous screen for the trailing PE. Potential dilution. The this is not really that big of a deal. Companies, when we look at their income statement, give us basic and diluted EPS. So we already have that number. For comparison purposes, the use of diluted EPS compensates for differences in convertible securities. So if we're comparing PEs across a bunch of companies, you may want to use the diluted EPS because it will compensate for that. Let's look at transitory company-specific components. One-time events that, well, should we really keep that in? That was a one-time event. It's not a trend. They're items not expected to recur, and they are usually removed to get at something called underlying earnings or core earnings, persistent, continuing, or core earnings. And companies usually report adjusted earnings, non-IFRS, non-GAAP, pro forma, so they help us out here. But let's be careful. They help themselves out. They want to lead you to a number of EPS that it makes sense for them. So if there's some confusion in the numbers as to what's recurring and what's not recurring, a company will usually help the analyst out by saying, look, here's our earnings per share for this quarter. Here is our non-GAAP earnings per share. And what they're trying to point out when they show their non-GAAP earnings is they're taking out the transitory non-recurring component of EPS to show what EPS would have been had that single little event not happened. And what they're implicitly saying in that is, look, this is not going to happen again. It was a one-time thing. That's history. You got to value us on a going forward basis, so really don't include this. You really should use our non-GAAP measure of EPS and not our GAAP measure of EPS. And I'll say a little bit about that coming up. So let's look at an example of what that looks like. Let's say that we have a stock, we observe a price of $50.11, and let's say for 2012, quarter 2, 3, and 4 have already been reported, and the company's reported diluted earnings per share of $3.71. We're in 2013 Q1, the company just reported diluted EPS of 81 cents. But in the notes of the financial statement, it said, look, we had in this 84 cents is 34 cents restructuring charge, and a 26 cents amortization charge of intangible assets arising from an acquisition. We don't think this is going to happen again. That's a 60-cent hit. That our core EPS should be 141 because this won't happen going forward. The earnings power in the company is $1.41 per share. This is a one-time event. So it also reports core EPS. So for the last 3 quarters of 2012, it's saying its core EPS was $4.60, not $3.71, and it's saying its core EPS here is $1.41, not $81. It seems like there's a lot of transitory events that keep recurring, and that's the idea, right? At some point, you got to look at a company and say, well, you know what? You're calling a lot of events transitory, but you seem to have a lot of recurring transitory events. The recurring sort of cancels out the transitory, don't you think? Well, that you as an analyst have to make that call. Are these really transitory events, or are these transitory events simply now part of the business model? It would be like saying, should I include SEC fines into my earnings per share forecast for banks? It seems every couple of years they're always getting fined. It's part of their business model. That if I were looking at a Goldman Sachs or Morgan Stanley over 5 years, I would say, well, look, I got to put at least a $500 or a $600 million SEC fine in there somewhere, because it's going to happen. We don't know where or when, but it's going to happen. They're banks. It's going to happen. So you have to look at these transitory events that companies are defining as transitory and say, are they really? Okay, well, let's just calculate some trailing PEs based on what we have here, and let's look at the difference between the transitory or core and versus diluted. So let's say that our price is 50.11, so we know we're going to have 50.11 as our numerator in both cases. It's just the denominator we have to worry about, the trailing 12 months earnings. Do we use diluted earnings per share, or do we use core? Let's say that we use the reported EPS. That would be 452, which is 371 plus 81. would give us a PE of 11.1 times reported earnings. So the stock is selling for 11.1 times reported EPS. If we look at the events and we say, you know what, yeah, I can see taking those out because the restructuring and the amortization or the acquisition were events that happened over the last 4 quarters. We would expect them to affect the last 4 quarters. In fact, looking back over the past 4 or 5 years, there was nothing there. So yeah, I'll believe the company. I'll believe them. Okay, good enough. Well, this makes our core EPS 601. Would give us an 8.3 times core EPS. Now, when you report your EPS number, you should make a distinction. It should be very clear which EPS you're looking, which EPS you use. If you say it's got an 11.1 EPS, 11.1 times what? You want us to be very clear, times reported earnings. In other words, you're signaling to your reader that you are not going to pay attention to the company's core EPS. You've read their justifications for it and you've dismissed it. So you're saying what they're calling transitory, you're basically implicitly saying, I don't see that as transitory, I see that as ongoing. But if you're reporting it as 8.3 times core EPS, you're signaling again that you are buying what the company is selling, that yes, these are one-time events, I agree, and on I go. Let's look at transitory business cycle components. They're transitory but repeatable. Well, that's a business cycle, isn't it? So if we take earnings per share, if we're looking at our earnings per share for a trailing 12 months, they are going to be depressed at the bottom of a cycle, which means at the bottom of the cycle we're going to have a high PE. And they are going to be high at the top of the cycle. So at the top of the cycle we'll have a low PE because here our denominator will be very small, here our denominator will be very large. Well, when we have a high PE, we would normally assume the company is overvalued, and when we have a low PE, we would say that it is undervalued. However, because the earnings per share here, the trailing 12 months, were at the bottom of the cycle, this high PE actually signifies that the company is undervalued. Now you're probably scratching your head, wait a minute, a high PE is undervalued because of where your trailing 12 months happened at the bottom of the cycle. At the top of the cycle, you will have a very low PE, saying, well, the company appears to be undervalued, precisely when we should be arriving at the conclusion that it is overvalued because this is a cyclical company. If it's cyclical, its PE will be counter-cyclical. This is called the Molodovsky effect. So it may signal that a high PE is actually undervalued. Kind of hard to keep it all straight sometimes, isn't it? So this is one of those learning objectives that just stand alone. It only applies to the PE that we're doing, and we're looking at something called normalized EPS. And this speaks directly to the problem that we left off on the last screen, which is if we're looking at trailing 12 months earnings at the bottom of a cycle, they'll have a very high PE precisely when we should be flashing a buy signal. And then high PE would signal overvalued. So what gives there? How do we deal with that? We would use something called normalized EPS, and this is the level of EPS expected under mid-cycle conditions. I've already defined mid-cycle earlier in this reading, and mid-cycle is the middle of the business cycle. We can use the historical average EPS for a company over the most recent full cycle. That'll get us mid-cycle. Problem here is it does not account for size. Over the course of a full cycle, the company may have grown significantly in size. So if you think about a business cycle looking like this, the company may have grown significantly in size so that if you took the mid-cycle average EPS, it might not account for the fact that going forward, your EPS are going to be significantly higher than the last mid-cycle. So that kind of has a bit of a drawback. A more mature company that's not growing very quickly might make more sense. We can move instead to taking the average return on equity from the most recent full cycle. That'll give us the average, and then multiply it by the current book value per share. So that'll get us somewhere up here. That looks a little bit nicer, but this only works if book value per share makes sense, if it is truly a driver of that return on equity. So let's look at an example here. Let's say that we observe the price of a particular security at $18.21, and we have earnings per share, book value per share, and return on equity over 2006 to 2012, suggesting that this is a full cycle. So we can look at the normalized EPS. We're going to look at just the historical average EPS only. And we're going to sum them from 2006 to 2012 and divide by the number of observations that we see, which is 7. So we're just going to simply add up all the EPS and divide by 7. And we'll get 0.79. 0.79. So if we calculated a PE based on normalized EPS of 79 cents, we have 1821 over 0.79, which would give us 23.1. 23.1. But look at EPS: 74, 63, 61, 54, 107, 88, 108. So if you look at 74 to 108, this is a company with much greater earnings power in 2012 than in 2006. But what we've done is we've sort of just taken the average in this cycle. We would expect the next cycle to take off from 108 and go higher. This might not represent a very good value. Let's just see what we get when we use average ROE times book value per share. And here is our ROE over the same period of time. So to get this, to get the number we have here, we're simply going to add up all the ROEs, divide them by 7 to get our average ROE, and then simply multiply it by the book value per share at 482, the last book value per share, because that accounts for our size. See, we went from $3 book value per share all the way to 482. So let's do that. What will we get? We'll get 22.6 as the average ROE, and we'll multiply that by 4.82. And we get $1.09 as normalized EPS. So if we calculate a PE using $1.09 as our normalized EPS, we'll get 1821 over 1.09 will give us 16.7. 16.7 versus 23.1. The 23.1 is almost 50% higher. So you have to make a call. Which one makes more sense to you? Because this is a growing company, because it has size and the average historical EPS does not account for size, you would discount that one and tend to use this one as the more valid measure of EPS, using the normalized EPS with this approach. Okay, so let's just finish up trailing PE with a few notes on adjustments, going from reported EPS to core EPS or underlying EPS. The adjustments that you make to EPS do not have to be the same as the adjustments the company makes. So a company that reports reported earnings for the year and core or adjusted earnings per the year, you don't have to take their number. You can look at their number and say, you know what? You're including things in here you're calling transitory that, based on my eye, looks like they repeat quite often. Even though they're events, these events seem to happen with recurring frequency. So I'm going to leave them in, or I'm going to leave some portion of them in. The example I used of including at least one SEC fine in a 5-year forecast for any bank, that makes sense. It's going to happen. You can't predict when, but you can predict it's going to happen within a 5-year period, I think with a high degree of probability. So it would make sense that that's just part of the business model of a bank. I don't know what year I'll put it in, but I'm going to put it in that 5-year forecast somewhere. Maybe I'll amortize it over the 5 years. Adjustments require detailed work. So that's the whole section on FRA. You have to be able to pull apart these numbers, and you have to be able to comb through the notes of the financial statements to say, okay, well, this may be non-recurring, this may be recurring. Some non-recurring charges don't actually appear as non-recurring charges. They may actually be in the continuing operations section of the income statement. And finally, we talked about differences in accounting methods. The financial statement analysis usually is done early in the analysis, so you've already done a lot of the adjustments you need to EPS or to net income, such as LIFO to FIFO or depreciation methods assumption. You've already made all the adjustments that you needed to. Let's move on to looking at low, zero, or negative EPS. And this is our ratio, price to earnings, P over EPS. If you have a small EPS, you'll have a very large PE. This gets very large without bound. As you get to 1 penny, the smallest you can get is a penny. This ends up, take the decimal places right out of the price. So if it's a $10 stock, you have a 1,000 PE. Does that make any kind of sense at all? No, it's a useless number. What if it's 0? Well, you can't divide by 0, so there's a limitation there. Negative PE, again, makes no sense. That's suggesting that somebody will pay me a certain amount of money for every dollar the company loses. Well, again, nobody's going to pay you to take stock off their hand. You've got to buy it from them. Okay, so let's have a look at the earnings yield. I left you with the problem of low, zero, or negative EPS. And if we simply just invert it and put the price as the denominator instead of the numerator, earnings as their numerator, problem solved. This is called an inverse price ratio. It solves every problem with low EPS, solves a problem with 0, and it solves a problem with negative EPS. We get an earnings yield, and that's exactly what this is. Earnings per share divided by price, that's a yield. It's an earnings yield. Now, this can be done for all ratios, by the way, in the form, whatever price ratio we have, any ratio in the form price divided by some fundamental, you can simply invert it and you'll get a yield. So if it's price over dividends, if you invert it, you have a dividend yield. If it's price over cash flow and you invert it, you get a cash flow yield. So it doesn't just have to be an earnings yield. The learning objective for this one just specifically says explain and justify the use of earnings yield, E over P. But it applies to other ratios. Just keep that in mind. So let's look at an example of doing this. And we have some beer companies here: Molson's, Anheuser-Busch, Boston Beer, Craft Brew Alliance, and Mendocino Brewing Company. And we have their current prices, their diluted EPS trailing 12 months. So we have a trailing 12 months PE. 15.7, 11.8, 47. Look at this one. All a 615. And this is just not meaningful because it's negative. So if we were going to rank these in PE order, the Craft Brew Alliance has the highest PE, and Anheuser-Busch has the lowest PE, with one that's not meaningful at all. So this is hard to work with. But if we put it into an earnings yield, look, it fixes everything. The Craft Brew Alliance, which has the lowest earnings, the highest PE, trailing PE, ends up with the earnings yield of 0.16. So now you can actually put them in descending order, and it makes sense. So we see Anheuser-Busch, which has a very low PE of 11.8, has the highest earnings yield, 8.49%, followed by Molson's, which is attractive at 6.38. And we can see that the negative, we can handle a negative. Not only is it, we can get rid of the not meaningful, but it's negative 6.9 on the earnings yield. So now, problem solved. Each of the problems are solved. Low earnings per share are solved. Negative earnings per share will be solved because the earnings yield will just be a 0. Because for price to be 0, guess what? The company doesn't exist. We're not analyzing it. Okay, let's leave trailing earnings or trailing PE behind, and let's look at the forward PE, which is next year's expected earnings. And here's where I said, well, we have a bit of a problem in defining what next year's expected earnings are. We can do it 3 different ways here. We can take the next 4 quarters. So let's say this red X is exactly where we're pricing it. And the quarters that lie ahead of us are Q3, Q4, Q1, and Q2. Now we could be 3 days away from Q4. It still doesn't matter. It is the next quarter. So no matter where we're standing, it's the very next quarter. Doesn't matter. So we would simply, our earnings per share for the year would simply be Q3, Q4 plus Q1 plus Q2. the next 4 quarters. That's pretty objective and straightforward. No matter where you stand, just take the next 4 quarters that are going to happen. It could be the next 12 months instead of the next 4 quarters, the next 12 months. So here we are here. Here's then the end of Q4. So we have so many months left to the end of Q4. That might be X. Then we would have, it would fall into the next year by 12 minus X. So let's say this were 6 months. This would be 12 minus 6, which is the 6 months of the next year. So we might have a forecast for the current year and a forecast for the next year. So our earnings per share for the next 12 months would be X over 12 times the expected earnings per share in the first year, the year we're in, plus the difference in the number of months times the expected earnings per share for the following year. I'm going to show you examples of each of these. And the next year's earnings might be simply expressed as the next fiscal year. So here we are pricing it out here. We're in this current fiscal year. It might be the next fiscal year. So in other words, we're not even looking at any of these. We're just going straight to the next fiscal year. Or it might be in the fiscal year that's still yet unfinished, which means you might have some observed earnings per share and some yet unobserved, so that your next 12 months might include months that have already happened. So it might be kind of like a hybrid trailing forward. So you could say there's really 4 different ways to calculate EPS. But let's do some calculations here, and let's just so that we have some examples of how we would do this. Let's say that we're looking at IBM, price 184.15. It's early September 2013. The fiscal year, IBM's fiscal year, equals its calendar year, or equals the calendar year. The consensus earnings per share for 2013 is $16.19. The consensus earnings per share for 2014 is $18.35. What is the forward PE for this company? Well, it depends on how you want to calculate. We're not given quarterly numbers here, but this one's too simple. I mean, this is fairly straightforward. The next 4 quarters, right? These two get a little bit tricky, so let's do that one. We'll start with this one down here. So let's say that we were calculating the price earnings ratio for 2013. That is the current fiscal year. It would be 184.15 divided by the consensus earnings for 2013, which is 16.19. Now it's September. It says it's early September, which means 9 months, almost 8 months for sure have gone by, and then some few days in September. 8 months have gone by. There's 4 months left to the end of the year, but we're still going to use that year's earnings because there's still a forward component in there, however small. But we're being very specific that we're using this fiscal year, but this fiscal year isn't over yet, so it still would be under the definition of a forward EPS. Here we get 11.4. If we were using next fiscal year, PE 14, we get 184.15 over 18.35. This gives us 10. So we're not even going to consider the last 4 months here. We're going right into the next year and using nothing but the next fiscal year. So this is typically expressed as 11.4 times year 1 or 10 times year 2. Fiscal earnings. And when you see year 1 fiscal earnings, that's the year we're in. You just have to say, well, how many quarters are actual, how many are still forecasted? It could be none have happened. It's January 1st. So all 4 are yet to come, which would give you the same PE as using the next 4 quarters. All right, let's look at this one over here, next 12 months. Let's see if we can use IBM to figure this out. It is early September 2013, so let's say 8 months of the year has happened. We have another 4 months, or we could say, well, let's count September. Let's say September's in, and we have 3 months. We'll use the 3. It doesn't matter which one. It works out the same way. Well, not the same answer, but the process is the same. What is our numerator? Our numerator is price, 184.15. Now we need our earnings per share. If we say that there's 3 months left in 2013, it'll be 3/12 of 16.19, plus it'll be 9/12 of 18.35. And that'll give us 10.34. So you have an 11.4, a 10, a 10.34, and if the next 4 quarters would be different, we don't have them, but there's no reason why it shouldn't be different. It probably would be different. Depending on how you define next year's earnings, you'll get different forward PEs. So when you're a consumer of research, in other words, you're reading other people's research and they give you forward PEs, you want to say, well, hang on now. How are you defining the forward PE? Because if you got to compare 5 companies on a forward PE and their forward PE are all calculated differently, you can't compare that. You can only compare companies when you calculate their forward PE all the same way. Now, why would you choose one over another over another? You'd have to have some logical justification for doing that. There might be some justification for saying, well, the next 4 quarters make sense based on where we're standing. There's nothing different about the next 4 quarters. You might say, well, it's seasonal and a large quarter just passed. So let me just take the next 12 months to make sure I get a full season in the next 12 months. Or you might say, well, you know what, in this particular year, there's an event that hurt the industry as a whole. So rather than include that in, I'm going to jump right ahead just right to the next fiscal year. You might have some reason for preferring one or another, or the context may dictate that one makes more sense. Once you choose one and you're comparing companies, you must compare them all on the same basis of the forward PE. So let's do a bunch of calculations here just to make sure that we have it straight. Here we have it broken down by quarter. We have the full year forecast 2013-2014. We have 2 actual quarters. We have 2 estimated quarters in 2013. And of course 2014 is all estimated. It is now August 9th. The price of the stock is $12.20. What's the PE based on the next 4 quarters? Okay, well, if it's August 9th, this is September 30th. That means we're somewhere in here. This is the very next quarter. All we have to do is just look for where the next quarter is. So what is our earnings? Let's calculate that first. Well, we're 0.01 negative, and then we add 0.05 negative. Then we go to 0.07 and 0.08. We will have 0.09. So we take our 1220 and divide by 0.09. We will have 135.6. That's based on the next 4 quarters. If we're basing it on the next 12 months PE, we're going to go to the annual numbers, and we're August 9th. That's close to the beginning of August, so we'll count 5 months to the end of the year. So we will have 5 over 12 times the annual number, which is 0.05 negative. I've got it in brackets there. Plus, we would have 7/12 over 0.15, 0.15, and that's positive. Let's make sure that we have that right. And that'll give us 0.067 as our EPS. If you do the arithmetic on that, that's what you should get. So what our PE in this case is going to be the same. 1220 divided by 0.067 will give us 182.10. Fiscal year 1, well, that's 0.05. So that's easy enough. We can go right to the PE in this case. Is 1220 over 0.05, and that equals not meaningful. You can't divide by a negative. You'd get negative 244, but it's not meaningful. And finally, fiscal year 2, which is 0.15, our PE will 1220 over 0.15 will give us 81.3. So in this case, you could look at them and you could say, well, you know, which is the most relevant one? They're all kind of ridiculous in a sense, but which one is the most relevant one? You can get rid of number 3 altogether. Would we count the next 4 quarters or the next 12 months on this one? Well, we have some losses in here. Whenever we have losses in our EPS forecast that are eventually going to switch over to gains, we kind of want to get rid of them. But we also have to say, is this a transitory or a recurring event? If I look into the 4th quarter of next year, I see that they're losing money as well. I think I have a cyclical company here that does very well in the first 2 quarters of the year, sucks in the last 2 quarters of the year, and then does very well in the first 2 quarters again. So I'm more apt to leave that in. I would probably have a hard time choosing between whether I'm going to use the next 12 months or whether I'm going to use fiscal year 2. If I have an economic reason, a good reason to believe that this company's prospects are getting better year after year after year, then I'll stick with just the year 2 full estimate. If I don't, and I think it's just a cyclical company, I'm not that willing to do it. But it does appear, quarter over quarter, it is getting better quarter over quarter. Maybe its prospects are getting better. Leans more towards me choosing the 2014. I take extra time in doing this narration because moving from level 1 to level 2, you have to understand that there are no real clear answers. That everything really comes down to, can you justify the choice of what you're doing? So I'm going to hammer that again and again at multiple points along the way, because you have to start thinking or stop thinking in terms of objective answer, and here it is, to how do I justify the answer I get to. So let's look now at actual versus justified in each of the contexts that we've done, the trailing 12 months earnings and the next 12 months. In other words, a trailing PE and a forward PE. If we use an actual price divided by our earnings per share, our trailing 12 months, we have actual trailing 12 months. That's happened. We can look at it. You get an actual PE. If we're using our next 12 months, that's a forecasted, but we're using an actual price. If we use the intrinsic value instead, based on EPS, trailing EPS, we can arrive at a justified trailing EPS. If we use our forecast for EPS, we can arrive at a justified forward. We don't need a formula for this. All we have to do is come up with some intrinsic value, however we come up with it, and then we can look at a justified trailing and a justified forward. So our price and our earnings per share trailing 12 months, these are observed numbers. Our intrinsic value and our estimate for earnings per share, these are estimated numbers. In looking at our justified trailing and our justified forward, what drives it, we don't need a formula to figure out what drives it, by the way. A lower weighted average cost of capital, a lower required return on equity, a higher growth rate will result in a higher justified PE, whichever way we're looking at it. So let's look at an example down here. And let's say a company's fiscal year goes from April 1st, 2013 to March 31st, 2014. And in September, you do a valuation. You have an intrinsic value per share of the company of $67.22. The price in the marketplace happens to be $63.40. Your fiscal year 1 earnings per share, $6. We call it fiscal year 1 because that's the fiscal year we're in. We have an earnings per share of $6. And we're here April to September. We still have to go to the next March. Based on our analysis, what is a justified PE? And justified PE is just, well, if we're justifying a PE, it's justified on the fundamentals. It is the price we arrive at, V0, 67.22, divided by whatever our expected EPS is. And we expect it to be $6. So we divide that by 6, we get 11.2. If we had used price in the numerator, we're calculating an actual forward PE. We're using the intrinsic value in the numerator, we're calculating a justified PE. So that's all you need to do. Whether it's a 2-stage model, 3-stage model, 1-stage, H model, whatever the case is, whatever intrinsic value you come up with per share, if that's your numerator instead of the actual price, if your intrinsic value that you estimate is your numerator, you are calculating justified PEs, forward and trailing. If price, the actual observed price in the marketplace, is in your numerator, then you're not calculating justified, you're calculating actual, trailing, or forward. So here's another learning objective that kind of stands on its own. Calculate and interpret a predicted PE. You can do this with, again, you can do this with any price multiple. It doesn't just have to be a PE, but the learning objective just pretty much just says the PE, just the predicted PE, so we're going to let that stand alone. This is nothing but a regression equation. What you're doing is you're taking a bunch of companies, a cross-section of a bunch of companies, and you're looking at their PEs. And you're saying, well, what determines this PE? It might be this variable, it might be that variable, it might be that variable, and you take them all and you put them in a regression equation and you see what betas you get. And what loadings you get on each of the variables in terms of beta and how significant they are, and you modify it till you get 2 or 3 that pretty much hold a lot of explanatory power. So here's an example of one, a regression equation where you looked at a bunch of companies. You say, well, let's take them based on their dividend payout ratio, the beta, and their growth rate, and we'll do a regression on their PE. To see if we can then, if it has any predictive power in predicting what a company's PE should be based on observations of this. These are our explanatory variables. PE is our dependent variable. So let's say we run a regression analysis after a cross-section, using some cross-sectional data, and we have this regression equation where the PE is 12.12 plus 2.25 times the dividend payout ratio. Minus 0.2 times the beta plus 14.43 times the growth rate. And let's say that we have a, notice that the PE increases with a higher dividend payout ratio. We've already said that before. That's our numerator in a Gordon growth model. Expressed as a forward PE. Our numerator was the dividend payout ratio. So a higher dividend payout ratio, we get a higher justified PE. The beta is a measure of risk. So the higher the beta, the lower the PE. So instead of R, how do we get R? Well, we don't know how we get R. Let's just use beta. That's a measure of risk. So if we have a company with a beta of 2, notice that this is a negative. It reduces the PE. And our growth, the higher the growth, the higher the justified PE. So let's take ABC with a beta of 0.9, dividend payout ratio of 0.45, and a growth rate of 0.08. What is the predicted PE based on this regression and these fundamentals? It is going to be 12.12 plus 2.25 times 0.045 minus 0.2 times 0.9 plus 14.43 times 0.08 will give us 14.1. It should be selling at 14.1 times its earnings. That would be the predicted PE. So how do we get the price of the company higher? Well, if it had a dividend payout ratio that were higher, it would justify a higher multiple. If it were less risky, it would justify a higher multiple. And if it had higher growth, it would justify a higher multiple. We know that. We already knew that. This is just a way to express it in a formula, in a regression formula, that we can then just plug in our observed company's fundamentals into it and get a predicted PE. Problems with doing this: useful only for trailing 12 months. The predictive power of this is questionable. Doesn't really have that kind of predictive power that we would like it to have, but it works well for trailing 12 months. But we already have observations of trailing 12 months. Relationships between PEs and fundamentals are not stable over time. And the big one, this should have been obvious almost right away, multicollinearity. What does multicollinearity mean? It means that a series of data on one variable is partially or somewhat derived by a series of data on another variable. So let's say that we're looking at what dictates a person's grade at the end of the semester. And we might have a couple of variables. Well, one variable might be directly related to another variable, which means it's not really a separate variable altogether. So that's why we call it multicollinearity. So that we might say, well, time spent on the assignments, time spent doing the assignments dictates what your grade is. But you might have another one that says time spent studying. Well, guess what? One sort of dictates the other. They're the same variable. Now look at what we have here. You have a beta and a growth rate. Beta in this one and a growth rate. Would not the same fundamental driver that increases your growth also be the one that lowers your risk? And if it does, then you have multicollinearity. If you've done the regression or the quantitative series so far. We've been through multiple regression. You understand what that means. Okay, well, let's look at comparables now. We've looked at fundamentally forecasted PEs. We've got a hold of trailing PEs, forward PEs, the multiple ways in which we can define what the next year's earnings are. Justified PEs, predicted PEs, great. Now let's look at comparable PEs. And as I said before, this is not a nice to do. This is a need to do. It's one thing to come up with an intrinsic value for the company and calculate a trailing or a forward PE based on that and decide whether that's over or undervalued on its own. But you want to see what other assets are priced at. And comparables allow you to do that. And I think it is absolutely necessary, not just to determine a value yourself, but say, okay, well, here's the value I come up with. But what does the market say that other things like this are selling at? Because really, that's what the market will bear. That's a better indication of how I'm going to turn something into cash or how much cash I have to part for something. So we've seen comparables before. I'm not going to spend a lot of time giving you the background on it. We'll just do it very quickly. A comparable is, what we're doing is we're looking for a benchmark value of the PE or whatever multiple it is. Here it's a PE. So we're looking for a benchmark value. And we get that benchmark value by looking at the average or median value of the PE for the company's industry, the company's sector, or the company's peer group, or even an index. I'll expand more on the index later. But the average or median value for that versus the average past values of the PE for the stock, whatever stock we have in question. And you have to look at it relative to the industry, the sector, the peer group, or the index. So you can't just look at 1 year and say, look, the peer group has a PE multiple of 20. Our stock has a PE multiple of 15. It's clearly undervalued relative to the industry. Hang on a second now. You have to look at the past value of the PE relative to the industry. If it's always been undervalued, then you can't say it's undervalued. So if the PE has always been, let's say, 75% of what the peer group is, then if it's still just 75%, it's right where it should be. So you have to look not only at where you sit in relation to the peer group, but where you've always sat in relation to the peer group. And I'll show you some examples of that as we go through. So when we have the benchmark value of the PE, we can take that benchmark value and multiply it by our target company's EPS. And we might have some subjective adjustments to the PE, to the target or the peer group PE that we get, or the industry or the sector PE. We can take that benchmark value, multiply by a target EPS to get an intrinsic value for the company, and we can compare that intrinsic value versus the actual price. And we can make that comparison and determine whether there's an under or overvaluation occurring. Alternatively, we can compare the benchmark PE versus the target PE. And we can make a comparison whether the target PE versus the benchmark PE is telling us anything about whether the stock is under or overvalued. And we can ask ourselves the difference between the intrinsic value we arrive at based on the benchmark times the EPS versus the actual price, or the target versus the benchmark. Are these differences explained by the differences in the fundamentals of the the peer group versus the company that we have? Differences in growth and risk. These are the two things. Now, why growth and risk? Because if you look at your denominator, what do you have? R minus G in your when you're calculating either terminal value, or you're just using a one-period dividend discount model, or even a cash flow model, or whatever the case is, it'll always be R minus G. R could be the weighted average cost of capital, but it's R minus G. So we want to know, are differences in the PE explained by any of these two variables? Growth, asset turnover, and profitability, so we can look at our target company versus the industry average, or the sector average, or the peer group average, and say, do we have better asset turnover? Do we have better profitability, or weaker? Maybe we need a discount. If the industry is trading at 20 times and we have worse asset turnover and worse profitability, maybe we should be 17 or 16 times earnings, right? And R for risk, we can measure the risk of our company, our target company, by liquidity, by coverage, or by leverage ratios. So we have a bunch of ratios that we can then go to. Think of this as, our target house. And these are rooms in the house. How many bedrooms does it have? How many bathrooms does it have? And that's all we're doing. Okay, so fine. The average selling price in our neighborhood is $320,000, but that's for a 3-bedroom, 2-bathroom house. We can look at our bedroom bathrooms in terms of ratios. I'm just giving you an example of what we're really doing in case you think, well, it's kind of confusing, this ratio and that ratio. Think of it in terms of this is just a house and we're just counting the rooms. So let's look at an example, and we'll use this screen and the next screen to play out the example in full. But let's say that we've selected a number of companies in the telecom sector, AT&T, BCE, you can see them all here all the way down to Windstream. 1, 2, 3, 4, 5. We have 7 in the peer group. We have a mean trailing PE, that's our valuation metric here is the trailing PE, and we have a median PE. So one of the things we can point out here is which one should we use, 50.95 or 36.91? We have Equinix, EQIX, a PE of 131.28. We might come to the conclusion and say, you know what, that doesn't appear to be a very meaningful PE. So if we were adding up all 7 and taking the average, which is the mean, the 50.95 would be dragged up by this one. So it doesn't make a lot of sense to use that one. That might be misleading. I'm apt to classify this one as an outlier. But if I rank them from the highest to lowest and I take the middle value, which is the median, it removes the effect of this one pulling up the PE. In fact, this could be 10,000 and it still wouldn't change the median PE. So in a case like this, I would be more apt to take the median PE of 36.91. Well, now here's the conclusion that I'm wondering about. The first 3 companies, are they undervalued? If the median PE is 36.91, AT&T, BCE, and CenturyTel all appear to be undervalued. Frontier and Verizon appear to be overvalued. Should I short $50,000 worth of these 2 stocks and buy $50,000 worth of those 3 on a nice pairs trade? I'm long short in the same sector. I'm long undervalued stocks and I'm short overvalued stocks. If I take a naive look at the PE, first of all, I'd never do that on a trailing PE, by the way, because I'm shorting the future, not the past, and I'm buying the future, not the past, so I'd never do it on a trailing PE. But given what I have, someone might come to the conclusion that, well, you know, these 3 appear to be significantly undervalued. Verizon, the target company that we're interested in, appears to be significantly overvalued. Well, if we divide the PE ratio by the growth of the company, that helps us to price in, well, maybe one company just happens to be growing faster than another company and justifies a higher PE. So that's called a PEG ratio. We take the PE and we divide it by G. And the belief is that if it is less than 1, we have a company that's undervalued. If it is equal to 1, we have a company that is fairly valued. And if it's greater than 1, we have a company that is overvalued. Now, much as the PE ratio doesn't account for growth or risk of the company, the PEG ratio has its own problems as well. While we appear to be controlling for growth, it does assume a linear relationship between the PE and growth, which is not really a big deal on its own. It ignores risk, which, well, you can't control for everything. We know we still have to deal with risk. The biggest one, and this is the biggest one and the most misleading one for using a PEG ratio, it does not account for differences in duration of growth. Let me give you an example of that. Let's say we have a company. Where will I write? I'll write at the top here. Let's say we have Company A and Company B. Company A is expected to grow at 20%. Company B is expected to grow at 15%. And they both have the same PE ratio. Company A will have a much lower PEG ratio than Company B because it's expected to grow at 20%. But it's going to grow at 20% for 3 years, and then it's going to grow at 5% thereafter, whereas Company B is going to grow at 15% for 15 years and then drop to 10% thereafter. Suddenly, B should be valued higher because it has much more significant growth, 20% a year for 3 years and drops to 5. Look at the duration of this growth, 15% for 15 years. The PEG does not account for differences in the duration of growth. All right, so let's do this again. Here are our companies down the side here, our mean and our median. Here are our trailing PEs. Now we're going to put forward PEs in here as well. And I really think everybody, whatever you're doing, you should always focus on forward PEs, but we'll put the forward PEs in. We have our 5-year earnings per share growth forecast. And so EQIX is going to grow at 25.3%, and they're all ranked in order of growth. So the highest growth company is first, the lowest growth company is last. That's when it's expected to shrink. So we have a mean growth rate of 8.08% or a median of 6.46%. And let's calculate a forward PEG. So if the forward earnings for EQIX, the forward PE is 43.97 divided by its growth, look at its PEG, 174. Notice the difference between the trailing and the forward here. Trailing was 131, forward was only 43.97. Well, that makes a lot more sense. Suddenly, this is not an outlier. On the last screen, we were asking whether these three companies were undervalued. Whether they were undervalued because they had, if you look at their PEs, they were all lower than the median PE of 36.91. Well, once we account for growth, this is a 5-year growth forecast, not just next year, but a 5-year growth forecast, and we take their forward PEs, we'll solve two problems at the same time. We'll look to the future because that's what we're doing, and our growth rate is future looking as well, so you want to use the same time frames. We have our PEG ratios all in line. Look at the PEG ratios of the three that may have appeared undervalued by a naive look at a trailing PE. 195, 471, 892, 8.92. Remember, anything over 1 we would consider overvalued. So suddenly CTL at a forward PE of 12.04, at a trailing PE of 18.86. The industry was, we said 36.91 for the peer group. We're at 18.86. We thought, well, that's probably significantly undervalued, but look at its growth. It's hardly expected to budge, 1.35. That's inflation. So on a real basis, it's not going to grow at all. So its forward PEG, 8.92, tells us that no. Contrary to what the trailing 12 months PE is telling us, the PEG ratio is saying once we consider growth, this company's not undervalued at all. In fact, it's extremely overvalued. What is undervalued? Well, look at this one over here. FTR is extremely undervalued. It had a trailing PE of 43.30 versus the industry at 36.91. We were thinking that, well, that clearly looks like it's overvalued. We would have been shorting FTR and Verizon, and we would have been buying BCE and CTL. But once we get over here, that's the last thing we want to do. We would have been wrong. Or at least it looks like we would have been wrong because we didn't consider the growth rate. Once we consider growth, it doesn't look so good, right? Now what we can do is we can also look at the betas as well. And that allows us to look at risk. Sure, the PEG doesn't account for risk, but we can add beta on to the end. If we look at these three that we thought were undervalued, that now appear to be overvalued, as far as risk goes, well, they have a fairly low level of risk, 0.4, 0.76, 0.89. But if we look up here at FTR, it still has a PEG ratio of 0.86, below 1, without a significant increase in risk, 0.78, which is still, it's pretty much in line with BCE. It's less than CTL, 0.78. It's less than EQIX. It's the second lowest one we have with the lowest PEG ratio. Suddenly the one that looked overvalued, once you look forward, account for growth, and check risk, suddenly, you know what? There we go. Listen, you're never just going to walk along and find $10 laying on the ground in the market. It's just not going to happen. You have to break into somebody's house, ruffle through their drawers, and steal that $10, which means you got to start thinking in terms of this 2-3 moves ahead, right? So that's a good way to sort of look at how the PEG ratio would help us take it one step further. But remember now, it does look at growth, but beyond this 5-year forecast, it doesn't do anything. For instance, FTR, 21.8 over the next 5 years, could drop to almost nothing. Whereas EQIX could be 25.3, not just for the next 5, but maybe for the next 15 years. So that if we did, instead of a 5-year EPS growth forecast, you did a 7 or a 10, these might all change. So just keep that in mind. So that's a good example of using a peer group, and that's all we did here. If we move now to an industry or sector level and look at multiples here, we get an extra benefit out of it. The larger the comparison group, the more likely that mispricing of individual assets cancel out. So that's kind of we don't have to worry about any particular outliers in there. Now, before we go any further on this, I said earlier that when we look at our comparable, whether it be an industry sector or peer group multiple, we want to compare it not just to the current multiple we have, but to a long-term average of the multiple that we have. Because if it's historically been lower or higher, we want to account for that. So here's a good example of one. Let's look at company A, company B, company C in relation to the S&P 500. So our price on A is $23, on B is $50, on C is $80, and the index at this time is 1569.19. And the PE on A is 12.5, the PE on B is 25.5, C is 12.5, and the S&P is 17.9. There's our benchmark, 17.9. But when we look at the 5-year average PE for company A, it's always been about 80% of the S&P 500 index as a percentage of the S&P. So it's always run about 80% over the past 5 years. B has over the past 5 years has run consistently about 120% of whatever the S&P was. So as the S&P PE fluctuates, B tends to fluctuate as well, but at about 120% of the value, and C runs about 105% based on a 5-year average. So A, B, and C, you can't just say, look, 17.9 is the industry benchmark, and let's compare everything to that, because if we do, A and C appear to be equally undervalued, and B appear to be overvalued. But B has justified a premium to the market for the last 5 years. If we don't expect that premium to the market to change, its fair value probably might be 20% higher than where the index happens to be. So we have to account for that in the comparison. So let's look at if we look at an adjusted S&P earnings, an adjusted S&P PE. Since the 5-year average, since A was running at 80% of the 17.9, that is the same as saying 14.32. So we have to compare the 12.5 to 14.32. So all we've done, just so that we're clear, is I've said is if our 5-year average PE for A typically runs 80% of the index, then we need to compare it to 80% of the index. 80% of the index is 14.32. So now we're comparing 12.5 versus 14.32. Let's do the same for B. If we have to compare it to 120% of the index, we would get 21.48, and for C, we would get 18.795. So while we looked at it just in the raw data, A and B appear to be equally undervalued. A now appears to be slightly undervalued. B now appears to be slightly overvalued, but C actually has gotten even more undervalued. 12.5 versus 17.9. Now it's 12.5 versus 18.8. So C is the company that would be of more interest once we look at it in that context. So let's stay with this idea of the index PE just a little bit longer. And there are two purposes to the index PE. Number one is we can look at a target company in relation to the index and use the index as the comparable. But what we're doing when we use an index as a comparable is we're comparing it on some basis. So if you take the S&P 500, what's the comparison basis? Well, it's size. It's a large cap index, so you're taking another large cap stock and using the index as the comparable for it, saying this seems appropriate. So what would be appropriate to use with the S&P would be companies like General Electric that are in multiple sectors, multiple industries. Well, that might make a lot of sense. But if you're looking at a mid-cap or a small-cap company in a particular sector, then suddenly it doesn't make so much sense. So you've got to find the context that it makes sense within. You wouldn't use the S&P 500 as a comparable against a small-cap biotech. So the other reason to look at the PE on the index is to ask an obvious question: is the market overvalued or undervalued or fairly valued based on its historical range for the PE? So when we're calculating, or when an index PE is calculated, it can be done in one of three broad ways. The easiest, simplest, and probably the wrong way to do it is to take all 500 PEs, add them up, and divide by 500, or however many constituents are in the index. You'd get a mean PE. Not really the best way to do it, because you might have in that index a number of companies with negative earnings that might have a negative PE, or companies with very low earnings that might have PEs that make no sense at all. So a better way to do it would be to rank all the companies from highest PE to lowest and take the middle one, or the average of the two middle if you have an even number of constituents. You can do that. Or a common way, a very common way, that the PE of the index is typically reported is as a weighted average of the PEs. So you take your constituents, for n being the number of constituents. If this were the S&P 500, we'd run from 1 to 500. For each company, we would look at the market value of the company as a percentage of total market value of all the companies in the index, and we would weight its PE by that much, and then move on to the next and the next, and this would build up to one PE that represents the index as a whole weighted by market cap. Problem is, the largest stocks heavily influence the calculated PE, so we take a step back from that and go back to the median PE. Use of the median PE for the index instead. You rank it from highest to lowest and take the middle one. That's pretty much a nice middle ground that doesn't have much difficulty with it. And we can compare that with our target company. If our target company doesn't fit well in any one particular industry or sector, that makes a lot of sense. The big question when we look at the index, though, is the index overvalued? And to answer that, or to help give us insight into that, we can compare it with the historical average PE. And here now, the time frame is important, because if you go back 20 years and you look at the average PE, it's different than if you go back 10, which will be different than if you go back 5. So you want to pick a time frame that makes sense. Also, the lower the perceived level of risk and the lower the interest rates are in the marketplace, and the higher the growth prospects, or the higher the actual growth in earnings, the higher the current PE. So the index can justify a high PE if interest rates are really, really low in the economy, because that would mean that the risk-free rates are really, really low, and that's a component of the required return if you think of CAPM. Or if growth prospects are really, really great, or believed to be, or perceived to be great. They don't actually have to be great. You just have to have a majority of the market that thinks an event means something really, really great. And they all could be wrong. 1999, 2000, that was wrong. So let's look at two different models that use the index PE in terms of determining whether the market is overvalued or undervalued. The Fed model, and this one has a lot of problems. In fact, I think once the Fed starts highly engineering interest rates, you can't even use the Fed model, which means as of 2008, 2009, the Fed throw it out. The Fed model doesn't work. So, and I'm going to show you how ridiculous the conclusion would be if we follow the Fed model. So this is the valuation of the equity market itself, and what you do is you take the earnings on the index divided by the price of the index, and you compare it to the yield to maturity on a 10-year bond. If the earnings yield on the index equals the yield to maturity on a 10-year bond, you would say that the index is fairly valued. From this statement alone, I'm uncomfortable. The earnings yield on a portfolio of risky assets being equal to the yield to maturity on a risk-free asset being fairly valued, I would say that the index is probably extremely overvalued if you're getting the same yield on that you can get on a risk-free bond, or the bond is extremely overvalued. One of these two. But listen, it's not my opinion. This is just the way it's written, right? When they're equal, it is fairly valued. When the earnings yield on the index is less than the yield to maturity on the 10-year bond, it is considered overvalued. Now, here's the problem. If you engineer a market such that you create a whole bunch of demand for the 10-year bond, which is what the Fed has done, created demand for the 10-year bond from themselves, you drive up the price of the 10-year bond, you lower the yield, you engineer a lower yield. But it doesn't stop there. You squeeze money out of that 10-year bond because there's no yield. You squeeze it into the equity market, which inflates those prices. And when you inflate those prices, you tend to lower that yield as well. So in a very highly engineered market where no price, now the price on the market and the 10-year are both engineered at this point, one just happens to be a conclusion of the other one, you got to throw this model out, because the lower the yield gets on the 10-year, the higher the price gets on the on the market, the more unrealistic the conclusion of the Fed model gets. And I'm going to show you on the next screen how completely unrealistic that price is today. The conclusion of that model is today. So staying with the Fed model here, if you just rearrange the terms, you can get to a conclusion such that the fair value of the S&P 500 is equal to 1 divided by the yield to maturity on the 10-year T-bond. As of June 2016, the 10-year yield to maturity was 1.4597%. 1.4597. So the justified PE on the S&P, the justified fair value on the S&P, is 1 divided by that yield to maturity is 68.5 times earnings. So the S&P should be trading at 68.5 times earnings, not 17. 68.5, given where the 10-year yield is. Well, if we take the 68.5 times the estimated 2016 earnings of 118.39, we get to 8109 versus 2001, versus the index was at 2001 point when I did this. And it should be trading at 8109, saying that there is the market's trading at 25% of its justified value. That makes no sense. But look what's in the denominator here. The lower the denominator gets, the higher the justified PE. So if rates get all the way to where they are in some countries, which are very close to zero, I'm not kidding, on the 10-year close to zero, there would be an astronomical rise in the justified price of the market of not just 8,100, but you can see that as this gets smaller and smaller and smaller, let's put it at 0.0001, just a little above zero. What should the index be trading at? 100,000? See? Low rates fail. You have an engineered market on the denominator. That's an engineered rate. That's not a market determined rate. As soon as it's engineered, you can't use it. It doesn't make any sense. So the Fed model is kind of garbage in this respect. Also, it does a few other things, or it has a few other problems. Number one, it ignores the equity risk premium, and it inadequately reflects the effects of inflation. Because in the S&P, in earnings, some of that inflation might not be able to get passed through, whereas on the yield to maturity, we naturally expect that inflation is a component of the nominal rate. So, to sort of help fix that, to correct for that, we have something called a Yardeni model. And this is saying the current earnings yield on the index is equal to the current bond yield, but not on a risk-free bond, on a risky bond. The current bond yield is the current bond yield, an A-rated corporate bond, which that's a smarter thing to do right away. So it's got the current bond yield minus B times LTEG. Well, what is this? This is a long-term earnings growth, or consensus 5-year earnings growth rate on the index, and B is a growth weight. How much the growth weight, how much weighting is given to LTEG. And that's statistically derived. It's been anywhere from 0.1 to 0.2 on this, plus some residual. The residual is just the error. So that taking this, we can get a justified PE as 1 over the corporate bond yield minus the long-term earnings growth. So this is the same as R minus G. That's all we're getting is R minus G. For every dollar, R minus G. What's every dollar going to be worth, right? R, we're saying, well, the corporate bond yield should represent risk because it will be the risk-free rate plus a risk premium. And G is the long-term earnings growth rate times some weighting, and it should be minus because more growth reduces risk. So the lower the corporate bond yield or the higher the long-term earnings growth, the higher the justified PE. So another way that we can use the PE on the index when we look at the historical average PE on the index is we could just compare the current value to the index to its own historical PE. We don't have to use a Fed model or a Yardeni model at all. We can just compare it to where it has been. So let's say that we look at a historical average PE on an index and we get a certain value, and let's say it's the 5-year average trailing PE. And we can track where the PE of the index is because it will fluctuate either above or below its 5-year average trailing PE. When it's below, we can say the index appears to be undervalued. When it's above, we can say, or at least conclude or have some evidence to suggest that it's overvalued. So we can arrive at a justified intrinsic value hey, look, this doesn't have to be an index. It could be anything. It could be a particular company that has some historical average PE, but we're just comparing a company's current PE to its own historical PE. We can come up with a justified valuation for a company by looking at our average, or an index, by looking at our average PE, whatever this number happens to be over here, multiplied by our most recent EPS. So if we say, look, this is the historical PE for this company. Let's have a look at what our EPS is at this point. We'll multiply our historical average PE by that EPS, and we can come up with some measure of intrinsic value. We can compare that with the price in the marketplace to determine if it's over or undervalued at that point in time. So let's look at an example here. 2008 to 2012. Here's some PEs, some trailing PEs that have been observed, 35.8, 19.8, 10, 23, and 15. We have a mean of 20.9, a median of 19.8. As we look at these, we might look at our 35.8 and say, well, you know what, that might be an outlier. Maybe we want to drop that off and just use the other 4. The other things that we have to consider in looking at our 5-year trailing average, changes in the business mix, changes in leverage. Did something happen over this period of time where our business mix significantly changed or the level of leverage significantly changed? Whatever happened in this period, if let's say that here there was a divestiture and here we took on significant debt, well, this is not going to be very meaningful in the 5-year trailing PE any longer. What about changes in the inflationary environment over time? And we're going to spend a couple of screens on this whole idea of inflation because it does change how we would look at the PE ratio. But have there been changes in the inflationary environment over time? Perhaps in 2008 there was a very high inflationary environment and it dropped into 2012. Now, it didn't, but I'm just saying, depending on what country you're looking at, maybe it has, right? So let's dig a little deeper into inflation before we get on to, we're almost done PE, by the way. We just have this and terminal value and we're done. So let's look at this inflation idea, and to help us see how inflation matters, let's start with a basic assumption. Let's take a company with no growth. Now remember, a company with no growth, we can calculate P0 or V0 as equal to our earnings or our dividend 1 period out divided by R. It's a perpetuity, right? That's all it is. So let's say that there's no growth. The only growth can come from inflation. So if the only growth that can come from inflation is in play, G then is inflation. So R minus G becomes R minus I, because I is now our growth factor, and our earnings, our 1 plus G, will now become 1 plus I. Okay, so there's our basic assumption. we're going to derive a value for a firm where earnings can grow at the rate of inflation and discounted by R minus G, because I is now our growth rate. Let lambda represent how much of the inflation we can pass through. We're going to assume that the company can only grow at the rate of inflation if it can pass it through. So all we do is we just add lambda in front of each of the i's in this model here. So let's just have a look at what it looks like. Let's say that inflation is 2% up here. That means we have 1.02. Our earnings will grow at 1.02 or 2% because that's the rate of inflation. But let's say that lambda is 0.5. We can only pass through half of the increase. Well, this will be 1 plus 0.5 of 0.2. It'll be 1.01. And of course, our growth rate will be reduced as well. R minus, instead of 0.02, it'll be minus 0.01. So that's what lambda does. That's our pass-through rate. If we can't pass through anything, this becomes 0. 0 times whatever inflation in is 0. E naught never changes, it's flat. And this becomes 0. It ends up as just E1 over R if we can't pass anything through. So now let rho be the real required rate of return, because what do we have in here? Well, this is the required rate of return, but it has an inflation expectation in. So let's take that inflation expectation out and call it the real required rate of return. So our numerator, instead of R minus lambda I, because it has inflation in there, becomes a common element that we take out. It'll be rho plus 1 minus lambda I. To help see how that is, because going from here to here can sometimes be a bit of a difficulty. Think about it this way. This is the real required rate of return plus some inflation expectation, and we are taking off of it the amount of inflation that we can pass through. So we're starting with a required rate of return that has inflation built in, and we're reducing it by how much can get passed through. Here, we're starting with no inflation here whatsoever, and we're adding to it the component that cannot be passed through. So the inflation expectation on the bottom is just the inflation that's left over that we cannot pass through. That's all that is. Now, if you divide each side by E1, you'll notice that in the numerator, this is E1. If E naught times 1 minus, that should be 1 plus. Let me correct that. 1 plus whatever this is. That's E1. That's just an expression for E1. So if you divide both sides by E1, we get a forward PE is equal to 1 divided by rho plus the amount of inflation that cannot be passed on. So, as I've said before, things always look better in the light of an example. So let's do one here. This is where we ended up, our justified PE, or our justified forward PE would be equal to this expression. For a company with no growth, we just want to see what happens to the PE when inflation is introduced. That's all. Differing rates of inflation and differing rates of pass-through. So we're going to take company M and company P, and we're going to have rho. This is our real required rate of return is 3% in both cases. Great. Here's our first scenario, and here's our second scenario. So let's look at our first scenario. Lambda, the pass-through rate, is 75% for both companies. Both companies can pass through 75% of the increase in inflation. However, company M will experience 6% cost inflation. Company P will only experience 2% cost inflation. So the justified forward PE for company M in this case would be 1 over, what do we have? We have rho 0.03, and remember, that's without inflation. That's a real required rate of return. To that we must add an inflation expectation. But if we can pass on all the inflation, then there is no inflation expectation. We can use the real rate of return. But if we can't, then the risk is that, well, the rate has to absorb some expected inflation, right? So we can pass through 75% for company M. So what are we leaving behind? We're leaving behind 0.25, which cannot be passed through, times the rate of inflation. In this case, it's 0.06. That'll give us 1 over 0.03 plus 0.015, give us 22.2. So that's a PE of 22.2. Let's look at company P now. Now they're both facing the same real required rate of return. They both have the same pass-through ability. Let's see what happens to the justified forward PE in this case. So our PE here is 1 over 0.03 plus, we have the same 1 minus 0.75, but instead we have 0.02. You give us 1 over 0.03 plus 0.005. And that will give us a justified PE of 28.6. Let's stop right here. Look at the effect of lower inflation. We have lower inflation, and we've held growth constant by assuming, okay, it's 0. And what we've done is we've used a real rate of return rather than modifying the rate of return for different levels of inflation so that we can have the same real rate of return on both scenarios, giving them the same pass-through rate, but the company facing the lower rate of cost inflation will trade at a higher justified PE than the company with the higher level of inflation. So, if you're comparing across countries, this is critical now. If you're comparing across countries, and I think maybe we want to use Britain here. Let's take a company in the UK that's involved in the same production process as a company in the US. The company in the US sources all of its material, and let's say that the inputs to the production process are commodities priced in US dollars. So the US buys its product in US dollars. The UK must buy its inputs in US dollars. But the pound has taken a pounding, hasn't it? So what happens to the UK firm? Well, their cost inflation has increased significantly. So if their cost inflation has increased, then what happens to their PE? That's going to put downward pressure on their PE, even if they have the same pass-through rate. You think, well, they can pass through their costs the same as the US firm. They pass through about 75% of their costs, even if they can pass it through. The company facing the higher inflationary environment will trade at a lower PE than the company that is not. And this is a good example to show you because we've taken growth out of it by assuming 0. The only growth can come from inflation. We've given them the same real risk-free rate, the same pass-through, and all we've done was we've changed the level of inflation. So within a country, not such a big deal. Any industry facing cost inflation, the entire industry faces it. So if your peer group is nothing but the companies in the industry, you've controlled for it by making sure that everyone is subject to it. But when you're comparing across countries, even in the same industry, one country, because of currency, because of maybe a lack of the materials needed in their country where they're importing everything they need and they have transportation costs built onto that, whatever the case is, if there's a difference in the level of inflation that each company faces in their own country, you must account for that. Look at the difference in this PE, 28.6 to 22.2. It's not negligible. It's significant enough to pay attention to. All right, let's look at scenario 2 and let's see what we've done in scenario 2. Here, rather than having different inflation rates, we've kept the inflation rate the same. So they're both facing the same real required return. They're both facing the same level of inflation, but they have different abilities on their ability to pass through that inflation. Let's have a look at what happens here. The PE for M is 1 over 0.03 plus 1 minus 0.9 times 0.06. And that'll give us 1 over 0.03 plus 0.006, or 27.8. The next company, P, is 1 over 0.03 plus 1 minus 0.7, not 0.9. Again, 0.06 will give us 1 over 0.03 plus 0.018. Which will give us 20.8. So, look again at the difference. They both have the same level of inflation, just one company is in a position that it can pass through its costs much better than another company is in the position to do so. So this could be two companies in the same industry. One has decided to compete on the basis of price as a cost leader, but has very little ability to pass through because they're working on thin margins. The other follows a differentiation strategy with a lot fatter margins, so that a small, the inflation of 6%, might only make up 15% of their final sales price. So the ability to pass through their price is hidden. They can smuggle it in so much more of their differentiation than you could if you just compete on cost. So company A can justify a higher PE because of its greater ability to pass through costs. So this is the result of higher pass-through. So we can see that lower inflation and higher pass-through will justify higher PE. So you must pay attention to inflation. In North America, there's no inflation. In many European countries and Japan, there's no inflation. But that's not true in other parts of the world. That's not true in India. That's not going to be true in the UK. That's not true in South America. So if we're looking at companies in different parts of the world, you have to say, well, now hang on. What's the inflationary regime look like? And what's it been over the last 5 years? And are these industries in a position to pass through? Let's take a look at terminal PEs. And what we're going to look at is calculating the terminal value of, when we're looking at intrinsic value, arriving at the terminal value using PEs as opposed to a discounted cash flow model. The key condition of a terminal value, even if we're using PEs now, you've got to remember our two-stage and our three-stage model. What is the major assumption we made about that last stage? The key condition of the terminal value is that it must reflect some sustainable long-term earnings growth rate. That was the assumption behind the Gordon growth model. It's dividends 1 plus G divided by R minus G. That G is the long-term earnings growth rate. Well, just because we're using PEs doesn't mean that goes away. So that still stays. So if we use a Gordon growth model in a two-stage or a three-stage model, whatever valuation we arrive at VN, we can look at our forecast for earnings at EN and get a trailing 12-month PE to compare it to other forecasts we have for other stocks. Or we can divide that value at VN by EN plus 1 and get a next 12 months PE. And these are terminal price multiples based on fundamentals. This is not determining the terminal price with a multiple. It is arriving at a terminal price and then seeing what the multiple is. For this learning objective, we want to pay attention to these next two lines here. This is arriving at a terminal value by using a benchmark trailing 12-month PE or a benchmark next 12 months PE. So we may find in a particular industry, given a particular growth rate, that a trailing PE or a forward PE of a certain number is the appropriate fair value of that number. So we can arrive at the fair value, or VN, of the issue by multiplying the benchmark PE by either EN, the earnings forecast for period N, to get our trailing 12 months, or by EN plus 1 to get our next 12 months. So these are terminal price multiples based on comparables. This is terminal price multiples based on fundamentals. Here we derive the terminal value first, and then we see what multiple that implies. Working with comparables, we take the multiple first and see what intrinsic value that implies. So let's look at an example, because like I say, everything looks better in light of an example. Let's say that we have a company with an average required return on equity of 10%, average dividend payout ratio of 0.45, the industry ROE is 13%. Our forecast for earnings in E3 is $3, and the industry average PE is 14.3. So we're going to use that as our benchmark PE, that 14.3. So calculate VN using this industry average. Well, that's simple enough. The industry average, by the way, when we're looking at this PE, that's a trailing PE. It will always be a trailing PE when we're looking at average PEs, because how do we get average PEs? We add up what we can see and divide it by the number. Well, what we can see has already happened, trailing. So V3 in this example will be our benchmark PE, 14.3 times, we have E3. Since this is trailing PE, we need trailing E, which is E3. Not E3 plus 1, which would be E4, but E3, so we multiply it by 3. We'll get 42.90. Now, if we were given an average PE, and we were told that that was based on we forecasted a bunch of peer group companies and we looked at a forward PE, we would multiply this 3 by its earnings growth rate. But since this is trailing, we would use trailing as well. What valuation would we get using a Gordon growth model? And once we get that valuation, we can see what multiple that would imply. So let's use the Gordon growth model for V3. We know that V3 is going to equal the dividend at 3, 1 plus G, over R minus G. So do we have our D3? We do. Do we have our R? We do. Do we have our G? Well, we're not given our G directly, but we can figure out our G. We know that G is equal to the return on equity times the retention rate, right? So our return on equity in this case, the industry average ROE is 0.13, and the retention rate on the average dividend payout rate is 0.45, so the average retention rate must be 0.55. So our G in this case will be 0.0715. So let's go ahead and put 3 times 1.0715 over 0.10 minus 0.0715. That will give us 50.76. So that would be the terminal value we arrive at with a Gordon growth model, given these assumptions that we have, 50.76. Using a benchmark PE, we arrive at 42.90. So we've got a bit of a range in there. Using the 14.3. If we take the 50.76 and we divide it by our dividends, we can use we'd like to get a trailing dividend on this instead of a forward dividend. So we'll use the 3 to compare it with this one, because this is a trailing, this 14.3 is trailing. So 50.76 divided by 3 will give you 16.92. So we'll put here versus 16.92. So what do we do with this? At this point, you're probably wondering, well, so which one would I use? Would I use the industry average or would I use the Gordon growth model? Well, the Gordon growth model is extremely sensitive to estimates of R and G. And we assume that, well, if we take an industry average, the more elements there are that make up the industry average, the more that overvaluations and undervaluations will cancel out. This will be closer to probably what the market is pricing in as the fair value of that industry as a whole. So we would tend to look at the comparable and say, well, given that the GGM is very sensitive to R and G, I'm looking at that 42.90 and I'm saying, well, maybe that might make a little bit more sense. I might find V0 two ways. I might find V0 by using 42.90 as my terminal value and discounting that back, or using 50.76 and discounting that back and saying, well, this sets up my range, perhaps. Only experience will help you lean one way or another. There's no way you can go through the list of, well, if this, then that, and then if this, then that, but if this, then that. There's just too many nuances to go through. Experience will tell you. All I can really do for you here is set up the flags and say, look, pay attention to this. At this point, you must make some kind of critical choice. What you base your decision on, well, again, experience will tell you that. Well, with PEs behind us, let's move on to some of the other price multiples we'll be looking at. These go fairly quick. Our next one is price to book. Book value represents on a per share basis. Now, all of these price multiples, by the way, are on a per share basis because price is on a per share basis. Once we get to the firm level value, if we want to look at book value as a firm as a whole, we would use enterprise value, which is the next set of multiples we'll be looking at. But right now, everything is per share. So book value represents on a per share basis the investment common shareholders have made in the company. So we get to book value per share by taking our shareholder equity and subtracting the total value of equity claims that are senior to common. Typically, that's just preferred shares. So we would subtract the preferred shares. We would also subtract any dividends in arrears to the preferred shareholders. So maybe a dividend has been declared but not yet paid. We would subtract that. Or maybe the preferred dividend has been canceled for a period of time, and it's cumulative, which means all those dividends build up and they must be paid at some future point. Well, you would subtract that. And then you would divide that by the number of shares outstanding. That would give you a book value. A very naive book value, let's be clear right now. That's just book value, reported book value. We're going to talk about adjustments to that shortly, but let's just be clear that we're just taking what's on the balance sheet, doing this small little calculation, saying, great, there's a starting point for our book value per share. Do I need to amend that? Why would we use price to book? The rationales. Cumulative balance sheet amount, so that it builds over time. Therefore, book value is greater than zero even when earnings per share are less than zero. Book value per share is more stable than earnings per share. It is appropriate for valuing companies composed chiefly of liquid assets. And we're going to see, because of some of the adjustments we can make, why this is so. But finance companies, investment companies, insurance, banks, etc., where the majority of their assets are liquid financial assets as opposed to non-financial, as opposed to like a manufacturing firm like a GM or a Ford, where the majority of their assets are non-financial. And that comes down to how they're reported on the balance sheet. And how they're reported on the balance sheet tells us what our book value will be. Continuing on with our rationales. Useful for companies not expected to continue as going concerns. So chances are the company will sell at its book value. But then again, you have to have a look at that. Is it still operating as a going concern and simply winding up operations over time, or are we looking at liquidated value? If we're looking at liquidated value, then price to book's not going to help us there. The drawbacks of using book value per share does not account for critical non-balance sheet factors. Human capital, reputation, brands. These add value to shareholders, but they're not listed anywhere on the balance sheet. It's difficult to compare companies with asset-related business models. For instance, two companies competing with each other. One has chosen a very asset-intensive approach, high fixed cost, low variable cost. Another one has chosen a less asset-intensive approach, high variable cost, low fixed cost. So capital versus labor-intensive. Kind of hard to compare those two. Accounting effects compromise the usefulness of book value as a measure of shareholder investment, because internally generated intangibles, internally generated brands, and internally developed patents are not included as assets. So one company, one pharma company, can buy a portfolio of patents from a small biotech firm and it's an asset. Another pharmaceutical company can develop internally intellectual property that it then gets a patent on. It's not an asset. How do you compare those two? Same with internally generated brands. If I buy a brand, I got an asset. I can list that as an intangible. But if I internally develop a brand with a lot of marketing and advertising, well, those are expenses. They don't show up as assets. So they're not included as assets. Now, if I buy the brand, it's an asset. Guess what? That adds to my book value, because my book value, shareholder equity, really is assets minus liabilities, right? But if I expense it all, my retained earnings account is going to be significantly lower because I've expensed it and I don't have that asset. So there are some drawbacks to using price to book. And finally, the book value reflects the reported value of assets and liabilities. Because remember, the critical identity of the balance sheet, or the balance sheet identity, assets equal liabilities plus equity. So whatever is reported for assets and liability, of course, will reflect equity. But some assets and liabilities are reported at fair market value, financial assets and liabilities. That's why we said earlier, for a company whose assets are predominantly financial assets, book value probably is a great measure because they are reported at fair market value. You'll get a better measure of shareholder worth, or book value per share. Some are at historical reported at historical cost minus accumulated depreciation. So that carrying amount may not reflect the real market value of it, especially for buildings. Let's say you buy an office building in a particular neighborhood, and over time the neighborhood builds up around that office building, so its property value is significantly higher. Well, you're listing that building that you bought at historical cost minus accumulated depreciation. Fair market value may be significantly higher. So non-financial assets and liabilities might not reflect true book value. Financial assets and liabilities might not reflect what's reported on the or its historical cost, but they get to be reported at fair market value. Now, here's the issue with this fair market value reporting over here. That's if there's a price. You might have some financial assets that just don't price very well. So what does the company do? It reports them at a model-derived price. So perhaps the fair market value is model derived. And if that's the case, you're going to have to ask some questions about that model and about how they arrived at that price, because even in times of stress, a model derived price will show less variability than fair market value would if there was a price. The other drawback, share repurchases and issuances can really mess up the book value per share. So let's look at an example of that, because it's easier to show than to describe. Colgate-Palmolive, back in 2008, its trailing PE was 23.55, price to book of 15.94, and shareholder equity of 2.48 billion. And then let's go to September 13th. Now, Colgate-Palmolive bought back a lot of their stock over that period of time. PE, trailing PE at that time was 24.84. Well, look at that. That's comparable. 23.55 to 24.84. It's increased 5.5% over that period of time. Price to book 15.94 versus 36.01. That's a change of 125.9% from 15.94 to 36.01. But look what happened to shareholder equity. 2.48 billion dropped to 1.53 billion. When a company repurchases shares at a price greater than book value, which it will. It will. If you look at any company's book value, it's not really anywhere near what the share price is. Overall book value per share drops. If a company's price equaled its book value, price to book would equal 1. Price to book would equal 1. If book value were half of the price, price to book would equal 2. So you can really see what price to book is in these relationships between Colgate-Palmolive in 2008 and 2013. So if you were looking at it in isolation, you might want to make some judgment about the price. But if you looked at it in terms of PE, you would say, well, we can't really make a big judgment about the price or the cost of the shares based on some multiple of something. So what happened to price to book? Share repurchase. So that can throw comparisons off if you don't account for that over time. And as we've seen when we talked about dividends, dividend-paying companies are declining, share buyback companies are increasing, which makes price to book more and more difficult to use across companies, because no matter what peer group you come up with, I guarantee you there's a couple in there that have bought back shares. That's going to ruin your comparability. Moving on now to determining book value. As we've said at the top of this section, book value per share can be found by finding shareholder equity, subtracting any senior equity claims, and then dividing that by the number of shares. And I said at the time that's a kind of a naive way to get to it. It's our first move. But from that, we need to ask ourselves, do any adjustments need to be made? Well, why would we make adjustments? Well, number one, it would make book value per share more accurately reflect the value of shareholder investment. Perhaps, and as we've seen with the financial assets and liabilities, they're listed at fair market value. Could we benefit from listing some of the non-financial assets at that value? The other reason to make adjustments is to make price to book more useful for making comparisons. One can think of IFRS versus GAAP, for instance. LIFO versus FIFO. We'll get into those. So here's some examples of some kind of adjustments that you would look at. Tangible book value per share. The book value per share that you come up with is really let's keep in mind, shareholder equity is assets minus liabilities, total assets minus total liabilities, and then we just amend it for any senior equity claims, but in there are total assets. Tangible book value per share says, just give me the tangible stuff. So it's shareholder equity minus the reported intangible assets. When I say shareholder equity, I also mean to imply that the senior equity claims are gone from that as well. Minus the reported intangible assets. Now, you can take them all out, or you can just look at them and say, well, hang on a second now. If some of them are separable from the company, perhaps I'll keep them in. If they're non-separable from the company, then I'll omit them. And a classical one that's non-separable from the company is goodwill. You don't buy goodwill. Goodwill is the excess that you paid. So what do you call that? Since you have to consolidate the two balance sheets, the excess has to be called goodwill. So perhaps you want to get rid of that, but keep anything that's separable. Maybe there's a patent on the balance sheet that can be sold separately. Well, that's probably an asset. It's a sellable asset. Maybe not saleable, but a sellable asset. So you might want to keep those. Again, judgment calls on that one. LIFO to FIFO. LIFO is an American, not an American, let's say it right. It's a GAAP accounting standard, whereas FIFO is first of all, any reporting for taxes is going to be FIFO. And any IFRS is going to be FIFO because LIFO is not allowed there. Well, that will result in different values for inventory, again, affecting book value per share. Significant off-balance sheet assets or liabilities should also be included. Let's look at valuation issues. First one, from forecasted fundamentals. And this is a bit of a journey here. The book sort of just gives you the starting point of a Gordon growth model and jumps all the way down to the conclusion. So that when you're looking at the conclusion, price to book is a function of ROE, G, and R in this particular format. Intuitively, it's hard to see that. So when you can't see something intuitively, you're left memorizing it. Well, there's just too much to memorize. So let's see if we can't figure out how this expression makes any sense. So if we start from a Gordon growth model, and we let price stand in for our intrinsic value, D1 over R minus G. Well, what is D1? That's dividends one period out. But we can express it a different way. We can say, well, that's earnings one period out times 1 minus our retention rate. And our retention rate, 1 minus the retention rate is a dividend payout rate. So if we take earnings times the dividend payout rate, we have dividends. So we see that our numerator is the same. Now, since ROE is our earnings over our book value, we can say that E1 is our book value times our ROE. So let's substitute that in for E1 here. We'll get our price is equal to our book value times our ROE, which is earnings, times 1 minus RR, which is the dividend payout rate. It's still D1. This is just a long way to write out D1. So nothing has changed. Divide both sides by B naught. So now we have our ratio here. Price over book equals, it'll get rid of this B over here, is return on equity times the dividend payout rate. Since G equals the retention rate times ROE, we can express the retention rate as G divided by ROE. So let's substitute G divided by ROE in for RR. We'll get ROE times 1 minus G over ROE. Well, if you expand that out, you'll have ROE times 1 minus ROE times G over ROE. The ROEs will cancel out. You'll be left with ROE minus G over R minus G. So what is this telling us? This is telling us that a justified price to book can be determined by the return on equity, the growth rate, the earnings growth rate, and the required rate of return. And we can see that price to book is an increasing function of ROE. So let's just look at it into an example, and then we'll revisit that idea of price to book being an increasing function of ROE. Here's what we arrived at, our price to book. And remember now, we arrived at our price using the Gordon growth model, and then we algebraically manipulated it to express it in terms of a price over book. So this will end up being a justified price to book. And if we take our ROE to be 12%, our required rate of return on equity to be 10% and our growth rate of earnings to be 7. We have a justified a justified price to book of 1.67. What this is saying is that given a company that has an ROE of 12%, an R or a required return on equity of 10% and earnings growth rate of 7%, a price to book ratio justified by those fundamentals would be 1.67. So we can take our book value, we can multiply it by 1.67, we would have a intrinsic price for that company, an intrinsic value for that price based on those fundamentals. So the justified price to book, as we can see, is an increasing function of ROE. The higher ROE is, the higher our ROE is, the higher the price to book would be, and that makes sense because, of course, the higher the price would be. So two stocks, and this is it gets a little tricky to sort of understand how we can use this. Two stocks with the same price to book. We have two stocks with the same price to book. The one with the higher ROE may be undervalued. So when we're looking at two companies with price to book, how do we determine whether one is undervalued or overvalued? Well, what if they have different price to book, but they have different ROE? Well, then it's justified. One with the lower price to book might have a lower ROE, and the other with a higher price to book might have a higher ROE. Well, now we're still nowhere because we don't know whether they're undervalued or overvalued because they have different price to books, but they have different ROEs. So what we have to do is say, well, look, given two companies with the same price to book, the one with the higher ROE must be undervalued. Another way of looking at price to book is in terms of residual income, and we haven't done this reading yet. But it's actually very straightforward. Imagine a company that only earns its required rate of return, and we've looked at this scenario before, where we've done this imagination where we say, look, let's take a company that earns no growth. It has no growth rate. It simply returns its cost of capital. It won't increase in price. It won't grow. So what will price to book be at that point? Price to book will be 1 because what we have over here is the present value of the expected residual income. Well, if all residual income is 0, in other words, it only earns its required rate of return, this whole term will be 0. The price to book will be 1. The second term is an increase in the price to book based on the present value of all future residual income. That is all earnings in excess of the required earnings just to meet its cost of equity. So if we find the present value of all of that, the higher the future earnings potential in excess of its required return is, the higher the price to book. In other words, it will justify a higher price relative to its book value. So here I've written, if the expected residual income equals 0, then price to book equals 1. We'll see more of this in the reading on residual income, but we get what residual income is, so this is a fairly straightforward statement. Valuation on comparables. When we're if we need to determine a terminal value on a stock, we can use a price to book multiple. The book value we would be using would be a trailing book value. And we must consider differences. We've already seen up here. We've got to consider differences in ROE. We said it right there. Two stocks with the same price to book. The one with the higher ROE may be undervalued. Two stocks with two different price to books and two different ROEs can't really say too much. One with a lower ROE might be supporting a lower price to book. One with a higher ROE might be supporting a higher price to book. They may both be fairly valued. We can't simply just look at the two and say, well, the one with the higher price to book is overvalued. You have to look at it in context of the variables that determine the justified price to book. ROE, R, and G. Let's move on to our next one, price to sales. And why would we use a price to sales? And again, sales will be on a per share basis. Everything here, every price ratio is on a per share basis. Sales are less subject to distortion and manipulation. That doesn't mean that they're not subject to it. They're just less subject to it than EPS. Sales are greater than zero even when EPS are less than zero. Sales are more stable than EPS. And they are appropriate for mature, for cyclical, and for zero-income firms. The drawbacks of using sales: a business must ultimately generate earnings and cash. So even if we're looking at a zero-income firm and using price to sales to come up with a valuation, that can only take you so far. At some point in the future, that company needs to be generating earnings. Otherwise, price to sales it should be zero. Share price reflects the effect of debt. Remember, when we look at the intrinsic value of a firm, and we're depending on the measure of cash flow that we're using, it considers the effect of debt, the capital structure, but sales do not. Thus, price to sales is a logical mismatching. It does not reflect differences in cost structures. Again, the difference between fixed cost heavy, variable cost light, or variable cost heavy and fixed cost light. And revenue recognition can distort the price to sales. We said up here one of the benefits was that it's less subject to distortion and manipulation, but I also said that doesn't mean it's completely free. Revenue recognition can distort that. Well, the price to sales has a rather interesting relationship with the price to equity ratio, so let's have a look at that. Look at this statement I have here. I think that's a fairly straightforward statement. Sales times our net profit margin equals net income. I think that's straightforward. Let's just rewrite that, and I'll do it on the side over here, and I'll just do it short form. Sales times our percentage margin equals our net income. Implies that sales is net income divided by percent. If you invert both sides, you'll get 1 over S equals percent over net income. Remember, this percent is just short for net profit margin. And then multiply through by price, you'll have price over sales equals price over net income times percent, which is what we have here. That if we take our PE ratio, this unit, and multiply it by our net profit margin, we should arrive at our price to sales ratio. So given a PE ratio and a net profit margin, we can calculate what the price to sales ratio would be with this little relationship here. If you do some more manipulation here and divide through by a PE ratio, our price to sales ratio divided by our price to equity ratio should equal our net profit margin. So just to see if all those relationships hold, let's try it out. Sales of $100 a share, net income of $20. That gives us a margin of 20%, and our price is $150. So let's just test these out to see if it works. Sales times our net profit margin, 100 times 0.2 is our net income of 20. So I think that was the easiest one to check. Let's look at the PE ratio of the company as it stands. Our price per share is $100. Our net income is 20. We get 7.5. There's our PE ratio. So let's check our second statement here, which is our PE times our net profit margin. Let's see if we can get there. Our PE is 7.5. Net profit margin is 0.2. So 7.5 times 0.2 equals 1.5. Our price to sales should be 1.5. Let's find out if it is. Our price is 150. Sales per share is 100, is 1.5. There we go. So it's a nice little relationship that if we're given two ratios, price to sales and price to equity, from that we can come up with net profit margin. So let's take a closer look at our denominator here. We know our denominators are sales per share. So let's deal with that, and then we'll talk about, well, what do we mean by sales? So the price to sales ratio is the price that we can observe in the market divided by our annual net sales per share. And so we're typically looking at our most recent fiscal year. You can look at the last 4 quarters, but typically when we look at a price to sales ratio, it's the most recent fiscal year. So let's take a situation, sales of 10,814 million. Number of shares, 786.6 million, and a price of 672. Let's calculate our price to sales. In this case, we have 672. What is it, our denominator? We need our annual net sales per share. So our sales are 10,814.8. It's in millions, divided by 786.6, and that's in millions. So I don't have to worry about any the number of decimal places. They're in the right order. That will give me 672 over 1371. So price to sales here is 0.490. Great. So we get the idea of sales per share. We find it just by taking our net sales and looking at the share count. But what's in sales? That's what we need to pay attention to. Are there any revenue recognition issues that we should be aware of? Well, are there any significant barter issues? When we talked about revenue recognition back in level 1 for FRA, we looked at the effect of barter. You can take two internet companies, A and B. A decides to sell to B $1 million, $1 million of banner advertising, and B sells to A $1 million of banner advertising. Both of them have revenue of $1 million. Both have costs of $1 million. It nets out to zero, so there's no tax hit from doing that, but they can both show that they've generated $1 million in advertising, especially if they know they're being priced out on a price to sales ratio. Well, they'll do a lot of these barter transactions to get that sales up because we're not going to pay attention to their net income. We don't expect them to be making money, perhaps, at this stage of the game. Well, those barter transactions trading off advertising for other advertising, well, that can inflate sales and give the company a justified higher price based on a price to sales ratio that might be common for the industry. Bill and hold, where I bill a company for revenues, but I'll hold on to the goods and I'll be shipping at some later date. Well, maybe that was the wrong time to recognize that revenue. So we said one of the rationales for using price to sales was that sales are less subject to distortion and manipulation. We didn't say that they were not subject, but less subject. But they are subject to some form of manipulation here and there. So you just have to look at the company and the sales and say, am I considering all the sales, or are some of them questionable and I really don't want them? So let's look at valuation, and of course we'll start with valuation based on forecasted fundamentals like we've done for the other ratios we've looked at, and for price to sales. Let's look at our justified price to sales. If I gave you a price to sales ratio and I said, what drives the price to sales? Intuitively, we don't always see it. But if we can sort of express it algebraically, suddenly it begins to make a lot more sense to us. And this is all we're doing here. So we know that our intrinsic value is, here's a basic Gordon growth model, and let's P naught be the efficient price. So we're just going to assume efficient pricing, and there we go. Well, what is our dividend, D naught? It is our earnings multiplied by 1 minus the retention rate, our dividend payout ratio, right? So earnings times the dividend payout ratio is D naught. So let's expand it out and express it. By the way, if you ever want to find nice relationships in very tight formulas, and you're not quite sure exactly what you can read into it, take each of the variables and start decomposing the variables. That was the whole idea behind the DuPont composition, which we will revisit at the bottom of the screen here. But every time you want to try to gain some insight into something, decompose it. And this is all we're doing. Let's decompose the dividend. We have earnings and the dividend payout ratio. So now we know, we can say right now that intrinsic value appears to be driven by earnings and a dividend payout ratio. So we can say more than just driven by earnings, or sorry, driven by dividends. So this will give us, this formulation will just substitute E, 1 minus the retention ratio for D naught, and let's divide through by our sales to get our ratio on one side. So price to sales, now we can say something about price to sales. Now this P in the numerator, because we're using our forecasted values here, this is a fundamentally driven price, not a market driven price. This ends up being a statement, what we have on this side, a statement for a justified price to sales. What's it justified by? It's justified by all of this. We divided through by sales. So what do we have here? We have E naught over S naught, trailing earnings over trailing sales. Well, what's earnings over sales? Think about it. If you take your earnings and you divide it by sales, you'll get net profit margin. Well, it's our net profit margin. Multiplied by our dividend payout rate, which again, think about what that is. That's really just our dividend, right? Multiplied by our growth rate, and of course discounted by R minus G. So what can we say about the price to sales ratio? Let's say we're looking at two companies and they have different price to sales ratios. Now, if that's all we're looking at, we might say, well, one of them is undervalued or overvalued relative to the other. But you can't say that in isolation. In isolation, you're guessing. That's just a guess because you're assuming everything else is constant. Everything is the same except just for the price to sales ratios. If we see two companies with the same price to sales ratio, do we say that they're both fairly priced relative to each other? Again, we can't say that. Why? Because the price to sales ratio is justified fundamentally by these variables. It is an increasing function of the net profit margin and the earnings growth rate. So you might have two companies with two very different price to sales ratios, but one company has a higher net profit margin and a higher growth rate than the other company, and both of those companies are fairly valued based on their net profit margin and growth rate with respect to the price to sales ratio. So you can't just look at one ratio and say just a series of ratios that way without considering the context that drives the ratio. Now we can also take our G and decompose it, because listen, our net profit margin is a driver of the price to sales ratio. We see here increasing function of the net profit margin and the earnings growth rate. But guess what? The net profit margin also is a driver of the earnings growth rate, and we can see that by decomposing G again is the retention rate times return on equity. We can decompose return on equity into all of these components so that we have elemental units. Net sales over sales, sales over total assets over shareholder equity. We've decomposed and we can see there's our net profit margin, here's our net income, which is part of G. So the price to sales ratio, a higher justified sales price to sales ratio is really driven by the net profit margin because that's an element, but net profit margin also drives G. So we can start to see how critical that net profit margin is in the price to sales ratio. Well, let's have a look at how this works in practice. Let's do an example. Let's say that we observe a company with a net income divided by sales of 9%, dividend payout ratio of 35%, long-term earnings growth rate of 7%, and a cost of capital of 9%. What would be a justified price to sales based on just this information? What would be a justified price to sales? Well, always trust your formula. E naught over S naught times 1 minus the retention rate, 1 plus the growth rate over R minus G. Always start there and then go hunting for your variables. Do we have E naught or S naught? Well, we're not given earnings or sales anywhere, but this is a ratio. What is earnings divided by sales? That's your net profit margin. What is net income divided by sales? There it is right there. So E is just another word for net income. There's sales right there, 9%. Equals 0.09 times 1 minus our retention rate is a dividend payout rate, and we're given a dividend payout rate, so we'll just put 0.35 in. And our G is 1.07. Divided by R, 0.09 minus 0.07 will give us 1.7. So here's what this is saying, because we want to interpret stuff we calculate, right? We're saying if we observe a company with these fundamental characteristics, the efficient price, the justified price to sales ratio based on this is 1.7. Is the justified price to sales ratio. So that if I were given a company with a certain observed amount of sales, and I can look at their number of shares, I can calculate their sales per share, rather than look in the marketplace at the market-derived price, I can say the justified price of this company based on those sales per share is this. Then I can compare that with the real price. So if I have a justified price to sales of 1.7, in the next statement I'm given sales per share for 2013. This is my forecast for sales, S1. Notice I'm at S1 now, not S0, S1, so it's a forecast. I forecasted my sales per share for 2013 to be 108.9. what is an intrinsic value for that company? Well, to find V naught, I've got a justified PE. I've got a justified price to sales of 1.7. And I know the sales that I'm forecasting. So given the fundamentals of the company, suggesting that a justified price to sales is 1.7, if these are the sales that I'm forecasting, my price must equal my justified price to sales times the sales that I'm forecasting, 108.9. I would get $185.13. So that is an intrinsic value, all driven by the model. Now I can take that price and I can say, well, what price do we really have in the market? And let me make an assessment whether we're over or undervalued on a price to sales basis. Remember now, I got to this valuation with nothing but the price to sales ratio, a justified price to sales ratio. Okay, well, let's give the price at 196.20. What do you think? Well, again, now, you can't just say, well, if the market has it at 196.20, the fundamentals have it 185.13, the market appears to be overpricing it. We cannot say that. Remember, these models are very sensitive to RNG, and we already know we're not looking for a point price, we're looking for intervals. So I want to know, how far off am I? 185.13 minus 196.20 over 185.13 will give me negative 5.98%. So my intrinsic value, that I arrive at, is about 6% lower than the market. Now, if I have a plus or minus 5% on my intrinsic value, 5% up and 5% down is my range for fair value, I would say the market has got this stock overvalued. But if my range were plus or minus 10%, well, this is 6%, I would say the market has it fairly valued. You'll notice that as we've been going through level 2, there are no answers. There are no this is the answer, yes, no, true, false, right, wrong. The answer is always, well, it depends. It depends on all of these other things. It depends on what else I'm looking at. It depends on the context. Is this stock overvalued? Well, it depends on the range I'm willing to accept from the intrinsic value I arrive at. I arrived at 185.13. If my bands are plus or minus 5, then yeah, it's overvalued. But if my bands are plus or minus 10, no, it appears to be fairly valued. Will I take 185.13 to be the intrinsic value? Well, probably not. I'll probably price it a number of ways. That will set up my range without me having to say plus or minus 5 or 10%. I might price it out with a few different models to see what the range is. So I hope you're getting used to the idea now that the answer that we get to is a lot fuzzier and not as clear as we would have seen in level 1. In level 1, we were really just looking at the knowledge base. Here we're looking at application of that knowledge base, and the world is fuzzy, so this process has got to get fuzzier for you. All right, let's look at comparables. And the most common comparable for price to sales that we'd be looking at are trailing sales. You can use forecasted sales, but most commonly we're comparing companies on a trailing sales. So let's have a look at an example here. 3 companies, GETI, SN, and BCR. The price to sales on a trailing 12-month basis we have for all 3, 2.14, 2.66, 3.07. Profit margin, trailing 12 months. Quarterly revenue growth, year over year. Total debt to equity for the most recent quarter, and enterprise value to revenue for the trailing 12 months. So we got a lot there. Number 1, GETI. That's our focus right now. Is it over, under, or fairly valued if we used price to sales only? Well, if we're looking at it, price is divided by sales, right? So how do we get that number higher? Clearly, don't say get your sales lower. You'd have to say, well, a higher price justifies a higher price to sales. So GETI, just looking at price to sales on its own, we might say it appears to be undervalued in relation to both SN and BCR. However, you can't really come to that conclusion. The next question says SN or BCR more closely comparable to GETI. Which one would you say? SN or BCR is more comparable to GETI? Okay, well, let's have a look at what we have here. We have our profit margin, and remember now our price to sales is driven by that. 8.8, 13.2, 6.25. So GETI has a higher profit margin than BCR. We would have expected it to have a lower profit margin, so SN appears to hold that relationship, but BCR doesn't. If we look at our G, our quarterly revenue growth, 7%, 4%, this has got much lower growth, much lower profit margin. Remember now, price to sales was an increasing function of our net income margin, and of our G. Well, it doesn't make any sense. Going from Getty to BCR, BCR is lower on both. And if we look at our enterprise value to revenue, it's very close. GETI and SN are very close, but BCR is sort of off on that one. So if you had to pick which one you'd more closely compare it to, SN appears to be the winner here. SN has a higher price to sales than GETI, but it also has a higher profit margin, although it does have a lower growth margin. GETI has a lower price to sales, but it does have a lower profit margin, although it has a higher growth margin. And they're both very equal in terms of enterprise value to revenue. So you'd pick SN. BCR appears to have some issues with pricing. Price to cash flow now. So let's look at the rationales for using cash flow. Cash flow is less subject to manipulation. Not saying that it's not, just less subject to manipulation, more stable than earnings. And it sidesteps issues related to accounting choices. Some of the drawbacks, some definitions of cash flow are simply just inadequate. Now we're going to see, before you start questioning why that's a drawback, what do you mean it's inadequate? That for the price to cash flow ratio, I've said P to CF. That's technically, we're going to see that I really shouldn't be saying it that way, but I just want to say that it's a price to cash flow ratio, regardless of what definition of cash flow you're using. We use the acronym CF to mean a very particular type of cash flow. Now we're going to see that some of the cash flows we use for this ratio are not the same measures of cash flow that we saw in the last reading for finding valuation. For looking at forecasting cash flow to the firm or forecasting cash flow to equity, we're not going to call that cash flow in the context of a price to cash flow ratio. Yeah, very curious, isn't it? So some of the definitions of cash flow that I'm going to introduce here are quite inadequate, and I think you're going to see that right away. Free cash flow to equity is the most appropriate, but also the most volatile of the cash flow definitions. So once we start to see that, oh, okay, I get it, free cash flow to equity is more volatile, yeah, so that would make the price to cash flow difficult to compare. So that's why we use other definitions of cash flow to sort of help with that comparability. Cash flow is still open to some manipulation, yes. IFRS, cash flow from operations, may not be readily comparable to GAAP cash flow from operations. All right, let's look at some of these alternative definitions of cash flow that are used particularly for this ratio. And here's the important point to keep in mind. Simple approximations are typically used. The idea behind this ratio, the price to cash flow, and again, CF, don't worry too much about that. I really should be writing it differently, but just keep in mind this title is really just meaning price to cash flow. We'll see that CF means a very particular cash flow here. But these simple approximations are typically used. It's not the rigorous cash flow that we arrived at in the last reading. It's really simple. Example number 1, and I make a point on the side here. This is not technically correct as a definition of cash flow, but for this ratio, this is a very well accepted definition of cash flow. Scratch your head all you want. It is what it is. It is earnings per share plus, we simply just add back depreciation, amortization, or depletion per share. And we call that cash flow. Now this particular cash flow we call CF. So P over CF means particularly this definition of cash flow. But for the title, I'm just saying price over cash flow regardless of the definition. I just keep that in mind, that it's not meant to mean this. But P over CF means this is the definition of the cash flow we're using, and it is for the last 4 quarters, so it's a trailing price to cash flow. So let's say that we have EPS of 28 cents from continuing operations. Notice now it's from continuing operations. We've taken out all the non-operating stuff, 28 cents. And our depreciation or amortization, we've calculated at $1.53 per share. And our current price is $24.06. So our price to cash flow will be $24.06 divided by, we add them up, earnings per share plus the depreciation per share. We have 13.3. Now you see a price to cash flow ratio of this. Whenever you see a price to cash flow ratio, the first thing you should say is, what's the denominator? How are you defining cash flow? Because I have in my mind what I think cash flow is, but I need to know what you think it is. If you see CF, that means it means particularly this, earnings per share plus the non-cash charges, primarily just depreciation, amortization, depreciation per share. Moving on to more technically accurate definitions of cash flow, but not exactly accurate yet, just more technically accurate. You could just use cash flow from operations. Look at the cash flow statement, take CFO divided by the number of shares. There you go. And from cash flow from operations, you can adjust as necessary to get to a better measure of cash flow. You can normalize CFO, much as we normalized earnings. You can normalize cash flow from operations. You can remove the non-recurring elements. And then, of course, if there's any IFRS issues where some things are thrown into operations where GAAP doesn't allow that, you can take that out. So you can get a little bit closer by using cash flow to operations, but it requires a little more work, especially if you're comparing IFRS and GAAP companies. You can go to a free cash flow to equity per share. This is the most accurate definition. The problem with this one is it may be difficult to compare similar companies with differing timing of CapEx. Perhaps you and I have both the same capital expenditures over a 5-year period, but you front-end loaded all of your CapEx into the first 2 or 3 years. I back-end loaded all of my CapEx in the last 2 or 3 years. Well, my free cash flow to equity measure in year 1 will be far different than yours because you front-end loaded all of your CapEx. But when we get to the last years, mine will be far different from yours again for the same reason, just in the opposite direction. So comparability will be very difficult. So using free cash flow to equity per share, while it's technically the most correct definition of equity for measuring cash flow, unfortunately it suffers from that from the problem that it doesn't account for the different timing of this CapEx. And of course, number 4, we can use the EBITDA per share, and we'll see that when we get to enterprise value, that's actually a very good measure. But for cash flow, the most popular one is number 1, is just CF. All right, let's take a look at the price to cash flow ratio in terms of valuation. We'll do, of course, the forecasted fundamentals, and then we'll follow it up with a comparables approach. The working this way, looking for a justified price to cash flow, is a little bit different than what we've done with price to sales or price to earnings or price to book. We can come up with earnings, book, and sales, and of course we can adjust those numbers. But we really have one definition of book. We have one definition of earnings, one definition of sales, but we have multiple definitions of cash flow. So to say a justified price to cash flow, well, now we got to be careful. A justified price to what cash flow? So we can't really do it the same way. So what we need to do here is, our first step is to develop or come up or estimate an intrinsic value for the company by whatever method we want to use. So our first step is to find V0 using the most suitable discounted cash flow model, suitable for, of course, the type of cash flows that we're looking at. Of course, you deciding whether we have a 1-stage, 2-stage H model or 3-stage cash flow. However you want to do it, you come up with an intrinsic value. Then we divide that by any definition of cash flow that you feel is appropriate for the firm that you have, and that is the justified price to cash flow. So it could be a justified price to CF, to CFO, to free cash flow to equity, or to EBITDA. So you see it's not quite the same. It's still a justified price multiple, but instead of our denominator being a one definition term like book or sales, of course modified and adjusted for whatever we want, these are completely different definitions of cash flow altogether. It's not like we're taking one definition of cash flow and making some modifications. We're starting from completely different places. So whatever justified price cash to cash flow we use, whichever one we use, the important thing still is that price to cash flow is still going to be positive related to G and negatively related to R. All we can do is look at the denominator and say, well, it's going to be positively related to G, we know that, negatively related to R. So let's just look at an example of what I'm talking about. Let's look at what we have here. These are all estimated numbers. We have our free cash flow to equity trailing 12 months of 7.96. Our cash flow, a definition of cash flow, our earnings per share plus our dividends. Our depreciation, amortization, etc. We get to $12 a share. We have an estimated G of 6 and an estimated required return on equity of 12%. Calculate an intrinsic value. This is fairly straightforward. To do this, we're going to need a real definition of cash flow. In our intrinsic value, we're going to use the free cash flow to equity. And of course, this is trailing 12 months, so that's 0, and it's 1 plus G over R minus G. So that will equal, I'm running out of room here, but you know what I'm doing, 7.96 times 1.03 divided by 0.12 minus 0.03 will give us 9110. That is an intrinsic value. That is an estimated value. Now, no matter what we divide that by, that's not a market price. That's a model-derived value that we think is an efficient price. Whatever definition of cash flow we divide that by is a justified price to cash flow. Just we have to say what cash flow we're dividing it by. So let's look at price to cash flow. In its CF is our denominator, meaning earnings per share plus our depreciation add back on. We said it was 12. So this is just as much a justified price to cash flow as any other one, because it's the numerator that tells us it's justified, because the numerator is model driven, not market driven. What are we going to get? We're going to get 9110 over 12, which will give us 7.6. But we can determine a justified price to cash flow by looking at price over free cash flow to equity as well per share, again trailing 12 months, P naught over that cash flow. That will give us 9110 over 796, which gives us 11.4. So when we look at a justified price to cash flow for this particular price multiple, we have to pay attention to, well, what denominator do you mean? So if you're going to compare, if you're going to do a comparison across companies of price to cash flow, the first thing you have to do is say, well, hang on a second, what denominator makes sense? And everyone must have the same, every ratio you calculate must be done the same way. Because look, even with the same company, you have a justified price to cash flow of 11.4. Somebody else can come along and say, no, you got a justified price to cash flow of 7.6. But what's your definition of cash flow? All right, let's look at its use in a comparable approach, and it's kind of hard to explain, so it's easier just to show with an example. Let's take Company A and Company B. Current price, $17.98, $15.65. Trailing cash flow per share. Notice it's CF now, so we know exactly what that means. Earnings per share plus, we're adding back the depreciation amortization, 184, 137. So our ratios of price to cash flow, 9.8, 11.4. Let's stop right there. Based on the price to cash flow only, based on just what we have here, we would expect Company B to have the higher growth rate. So if they're both efficiently priced, and the price to cash flow for A is 9.8 and this is 11.4, to justify a higher price to cash flow, it must have a higher growth rate or lower risk if we assume efficient pricing. Let's keep going. Let's look at our consensus growth forecast to see if that holds. We have a trailing free cash flow to equity per share, by the way, and our price to free cash flow to equity, we priced it out another way. And then we have our consensus 5-year cash flow forecast and our beta, which is a measure of risk. So beta is the same. So over here I said that company B should have the higher growth rate or the lower risk. Well, it has the same risk, so it must come down all to growth. Company B, based on efficient pricing, should have a higher growth rate. 10.6 versus 13.4. Company A has the higher growth rate. Company A actually has the higher G, and both have the same R, measured by beta. Therefore, Company A appears to be relatively undervalued. It should have a higher price to cash flow because it has a higher growth rate. So what do we make of this stuff down here, the price to free cash flow to equity? We're putting this in to show why we would use alternative definitions of cash flow. Let's look at free cash flow to equity. Here, the trailing free cash flow to equity per share is negative. So it's not meaningful. The ratio is not meaningful anymore. So you can't really compare based on that. So we want to find some kind of measure that is more comparable. And this could simply just be a difference in timing between CapEx. Perhaps Company B made a huge investment in CapEx and ended up with negative free cash flow to equity. Might have had positive free cash flow to the firm and negative free cash flow to equity. So because this is more variable, that's why we would use alternative definitions. And we're on our last one for this section before we go into enterprise value. This is the price to dividends. And honestly, no one ever uses that. It's not even used. The inverse of it is used, the dividend to price. This is just a dividend yield. So we're really just talking about dividend yield. The rationale for using that, the dividend yield, is a component of total return. And the dividend is less risky than the capital appreciation component. The drawbacks, the dividend yield is only one component of total return, and many stocks do not pay a dividend. So if we look at the dividend yield of stocks, it'd be 0. How do you compare 5 companies that all have a dividend yield of 0? Which one's overvalued or undervalued? Well, you can't really tell. They're all 0. It's meaningless at that point, right? So calculation of the dividend yield. You would think that's fairly straightforward, right? And this is it's kind of a little bit tricky in just the trailing dividend. So if we're looking at dividends and we're looking at trailing dividends, most people think, well, it's the dividends paid over the last 4 quarters. No, it's not. Let's say that over the last 4 quarters you had 15 cents, 15 cents, 17 cents, and 17. Most people would say, well, that's 64 cents. That would be the trailing dividends. No, because over the next 4 quarters, we wouldn't expect it to be 15, 15, 17, and 17. The next dividend that we get, we would expect to be what? 17 cents. So we want to look not at the dividends that were paid, but at the dividend rate that it was paid at. Well, it was paid at a rate of 17 because that's what we would expect going forward is the 17 cents. You're not going to reproduce 15, 15, 17, 17. The next one will be, if it's going to increase, it'll increase, but it'll increase from 17. So we take the last quarter dividend only and multiply that by 4. So the dividend rate is 68 cents. So the dividend rate that you're going to calculate will be different than it might be exactly the same, but if there was an increase during the year, the dividend rate will be higher than the dividends paid. So that is called the dividend rate. So our trailing dividend yield is the dividend rate divided by price, not the dividends divided by price. If we're looking at a leading dividend yield, it is the next 4 quarters of dividends. Even if there is an increase, we would put the increase in. It's the next 4 quarters, the forecasted 4 quarters. So let's have a look at the dividend yield in terms of the Gordon growth model again and looking at efficient pricing. And let's do some rearranging. We'll just multiply through. We'll get our price times R minus G equals our dividend 1 plus G. That's D1. And divide through by P. We'll get R minus G is D naught over P. There's our dividend yield, 1 times the growth rate. Let's isolate the dividend yield on one side. We get R minus G over 1 plus G. So we can see what drives or what would justify the dividend yield, we can compare dividend yields based on growth rates and required rates of return. And so this sets up a point. Rather than use price over dividends, a price ratio of price to dividends, we use D over P, the dividend yield. For comparables, relative yields are compared considering RNG, what we've just said here. That's how we know. Considering RNG, and we must also consider the safety of the dividend. A high dividend payout ratio may be risky because it's unsustainable. It may signal a cut. Remember now, really high dividends, 10, 12, 13, 14% dividends, they're a red flag. They're telling you, look, a dividend cut is coming because a company cannot sustain that kind of dividend payout ratio. So as I said on the last screen, you have to look at the yield in terms of RNG. And this brings us nicely into using the dividend yield in a comparables approach to valuing companies. So let's just look at this, and I think this is a really great example, which really covers all of the things that we need to think about here. Let's look at these four companies here: Duke Energy, Pepco Holdings, Portland General, and PPL Corp. And let's say that we were evaluating them based on their dividend yield. So we would rank them. Number 1 is Pepco, number 2 is PPL, number 3 is Duke Energy, and number 4 is Portland with 3.7. So if you rank them on dividend yield, you might say, well, at 5.6%, Pepco appears to be undervalued based on where everyone else is. The price should be higher to get a lower dividend yield. But you have to consider it along with, again, its G and its R. So let's do that. Let's look at POM. Let's look at the first one, 5.6%. But look at the payout ratio, not meaningful. How do you get a not meaningful payout ratio? That means you have negative earnings per share. D naught over EPS. So you have negative earnings per share, and it's paying out 5.6. So if it's got negative earnings per share, how long do you think that can continue and it can still sustain a dividend? So, well, there's a bit of an issue there. Let's go to number 2, 4.8%. Is that a clean one? It's got negative growth. Consensus earnings growth forecast negative 2.4. So that doesn't look very good. That long term, you can't keep that kind of dividend yield with this kind of growth rate. So PPL has negative earnings growth. Let's look at number 3, 4.4. Is this a clean company? Its payout ratio is greater than 100%. Not sustainable with low growth. Look at its growth, 3.66%. You cannot sustain a 110% payout ratio when you're only growing at 3.66%. Something has to break somewhere. Let's go down to number 4, 3.7%, the lowest dividend yield. Payout ratio below 100%, so that's sustainable. Earnings growth, 6.45. So it has the best earnings growth. It has a good payout ratio. Only PPL's got a lower payout ratio, but it's losing its growth rate is negative. So it looks like the one with the lowest dividend actually is the most attractive one. Now let's look at risk. If you look at the risk of all of them, Portland Electric is the riskiest one, but look, it's got a beta of 0.5. That's still low R. It's got the highest G. And it's got a low dividend payout ratio. The payout ratio is below 100. The dividend yield is 3.7. But remember now, if we're looking at total return is our dividend yield plus our capital appreciation yield, and we've already seen before that our capital appreciation yield is our G, is whatever we're growing at. So we can calculate a total return for each of these. What's a total return on POM? Number 1, TR will equal 5.6 plus 3.82 will give us 9.42%. And PPL, which is at the bottom, will give us 4.8 minus 2.4, which gives us 2.4%. I think we can eliminate that one right away. Duke Energy is 4.4 plus 3.66 gives us 8.06%. And finally, Portland over here is 3.7 plus 6.45, and that'll give us 10.15. So just by comparing the dividend yield, even though we can rank them, once we start looking at the G and the R, the growth rate, the risk, and the payout ratio, there are problems that we can eliminate, start eliminating some of them. And when we look at them on a total return basis, Portland General at 3.7 on the dividend yield still leaves plenty on the capital appreciation side. Well, we're moving on to enterprise value multiples now, and what we've covered in price multiples applies here. The big difference between them is while a price multiple was at a share level, an enterprise value multiple is at the firm level. So the most popular one, the most commonly used one, is enterprise value to EBITDA. And EBITDA is a measure of pre-tax, pre-interest operating cash flow, and you can't see me right now, but I'm putting air quotes around operating cash flow. It's not really a good definition of cash flow, but in a multiple like this, it stands in because if you use EBITDA across all the firms, that's comparable. EBITDA is a pre-financial leverage and pre-operating leverage measure, because it doesn't consider depreciation or amortization, so you can compare a capital-intensive and a labor-intensive business. It doesn't consider the amount of financing, so you can consider a highly leveraged business and compare it with a non-leveraged business. So it makes it a nice comparable measure in that sense. How do we get, well, we know what EBITDA is, how do we get to enterprise value? It is the market, basically we can think of enterprise value as this. If you wanted to completely own all the assets of a company, you want to completely own all the assets, what would you have to do? You'd have to buy up all the equity. So it's the market value of the equity, plus you'd have to pay off all the debt because the debt holders own some of those assets. You want to own them all. And so you'd have the market value of the debt plus the market value of any preferred. There, now you own all the assets, but guess what? Any cash or cash equivalents or marketable securities you can pay yourself back with. So now all that cash is yours. So you look at the enterprise value as the cost of buying up all the sources of capital minus any cash just lying on the shelves when you get there that you can stuff back in your pockets. The rationale for using an enterprise value to EBITDA measure: it is more appropriate for comparing companies with different financial leverage, of course. EBITDA controls for differences in capital intensiveness. Excellent. And EBITDA is usually positive even when earnings per share is negative. The big drawback with using EBITDA as a measure of cash flow, enterprise value to EBITDA, is it overstates cash flow from operations if we're making continual investments in working capital. So we have growing needs for working capital. So that's the drawback. I think you saw that right away. So we talked about what enterprise value is. So how do we determine enterprise value? Well, we have a price per share and we can multiply it by the number of shares. Right away, we can see that enterprise value will change day to day. Depending on the market price of the shares, enterprise value will change. Plus the market value of debt, and if the market value is not available, we can use book value. Plus the market value of any preferred shares, minus of course your cash equivalents and any marketable securities. To determine EBITDA, we will start at net income, add back our interest expense, net of interest income. So we're adding back the net interest expense. Adding back our income tax or whatever taxes we recorded, plus any depreciation and amortization. We don't necessarily have to do this. It's usually provided to you. You just have to make sure that what's in EBITDA is continuing operations. Sometimes some non-recurring good stuff ends up being dumped into EBITDA to make it look that much better. Now, here's where you want to pay close attention to EBITDA. And you want to, put your glasses on and really have a look at what's going on line by line in EBITDA. Keep in mind what it's suitable for. It's suitable to compare companies with capital-intensive business models that are highly leveraged. That's excellent. Now, they know that that is the metric by which they're being judged by, enterprise value to EBITDA. So their motivation is not so much to manage cash flow from operations, not so much to manage net income, but to manage EBITDA. Because if that's the metric that is the most suitable for valuing the company, you know they're going to pay attention to EBITDA. So they're going to try to manage that upwards. So everything above EBITDA, you want to look at very carefully. Are they sticking things in there that really should happen below the EBITDA line? Okay, so let's calculate an enterprise value to EBITDA ratio. And here's some information I've pulled out of the balance sheet. When we're looking at calculating enterprise value to EBITDA, we're going to look at the assets section of the balance sheet, and we're going to find all of the cash and cash equivalents and marketable securities that we have. We'll hop on over to the liability side under current liabilities and non-current, find all our debt components. Here we have a current portion of long-term debt and a long-term debt. If we have bonds payable, then we'd look in the notes and see exactly what those bonds are, find a market value for those bonds if we can, and use that price. We're going to assume this is private debt right here. And then we hop down to the equity section of the balance sheet. We'll find the number of shares outstanding, and all we need now is to look in the marketplace to find the price. And then we'll deal with our denominator in a second. But let's fill out our numerator. We're ready to go with enterprise value, which will be $63.06 times the number of shares outstanding. There's the market value of our equity, plus the market value of our debt. Well, we're assuming it's all private, so the book value will stand in for that, $17.83 plus $230, plus we have our preferred shares, and we see that we have no preferred shares. We could just put a 0 minus all the cash we can pay ourselves back with, $4,060, and that will equal $12,961, and that is our numerator. Let's go hunting for our denominator now. We need EBITDA for the last 12 months. We have the 9 months ended March 31st, 2013. There's 9 months. But I need the previous. This is Q1, Q2, and Q3 of 2013. I need Q4 of 2012. I have the 9 months ended March 30th of 2012, but I don't have Q4. When I look up Q4, I'm going to get the year ended. So I have the year ended for 2012, which is Q1 through Q4 of 2012. Here's Q1 to Q3 for 2012. So just the difference of these two will give me Q4. So 1612 minus 867 gives me 745. I have to add that to the 9 months that I have. So let's add that, 745. 1245 plus 745. What about my interest expense? I had 14 at the year end, 8 at the 9 month mark, so I must have added another 6 in that quarter. I can add 6. 145 minus 88 leaves 57, and 825 minus 486 leaves 339. So there we go. So now I'm in a position to figure out my EBITDA. My EBITDA is my net income. I add these two amounts. It's 1990. Plus, I'm going to add back my net interest. 35 plus 6 is 41. Plus, I'm going to add back my income taxes that I paid, because it's EBIT, earnings before interest tax. So there's my tax. 207 plus 57 is 264. And finally, my depreciation and amortization. I add these two numbers together, I will get 1270, which gives me a denominator of 3565, which equals 3.6. So the enterprise value to EBITDA multiple is 3.6. Now I can compare this with other companies out there. I don't have to worry who's got how much debt. This takes care of it. I don't have to worry who's capital intensive, who's labor intensive. This takes care of it. All right, let's move on to valuation issues using enterprise value to EBITDA. Can we talk about a justified enterprise value to EBITDA multiple? Well, we certainly can. All we need to know is, well, what drives EBITDA? And whatever EBITDA is an increasing or decreasing function of, will justify an enterprise value to EBITDA. So if I give you 5 companies and I rank them on enterprise value to EBITDA, and let's say they're 5, 4, 3, 2, 1, make it nice and simple. Could you say that the company with an EV to EBITDA ratio of 1 is undervalued compared to everyone else? No, you can't, because it might be justified. Once we look at what determines EBITDA, or the components of it, we might say, yeah, it's got an EV to EBITDA of 1, but that's perfectly justified given its fundamentals. Well, we can talk about a justified enterprise value to EBITDA, although we can't express it algebraically. We can express it verbally. It is positively related to growth in free cash flow to the firm. That should be obvious. And return on invested capital. Now, why not return on equity? Because this is firm level. And at the firm level, we're concerned with all the providers of capital. So we're concerned with not just the return on the equity, but the return on all capital, debt, preferred, and equity. We call that invested capital or total invested capital. So return on invested capital, which is our operating profit after tax, because, hey, the government is always the fourth provider, never puts up any capital, but certainly takes its dividends, right? Operating profit after tax divided by total invested capital. Now this TIC, this total invested capital, is kind of like enterprise value, except we're not taking the cash out. We can arrive at TIC by the market value of equity plus the market value of debt plus the market value of preferred. So whatever enterprise value we get to, throw that cash back in, there's your total invested capital. And of course, the EBITDA is negatively related to the weighted average cost of capital. Notice we're not using R at this point. R is an equity measure. This EBITDA is to the firm. Enterprise value is firm-wide. EBITDA is to all the providers. It's a cash flow to all the providers of capital. So we must use the weighted average cost of capital, which accounts for equity, debt, and preferred. So we can talk about justifying an EV. And here's what we're going to do when we do comparables right now is we're going to do just that. A, B, C, and D down here. Here's total invested capital to EBITDA. Here's enterprise value to EBITDA. And then we have our debt to equity, which will show you the difference in financial leverage, by the way. We have our profit margin, trailing 12 months, and we have our quarterly revenue growth. And our profit margin is a huge component of our free cash flow to the firm. And we have our growth, so we know exactly what we're looking at here. So let's have a look at each of these and determine if we can say something about A. Our big question here, A. Look at A. It's got the lowest of all. The TIC to EBITDA and the EV to EBITDA has got the lowest of all. Is it undervalued? Well, let's see if we can figure this out. First of all, let's look at TIC to EBITDA and enterprise value to EBITDA, and you can see the difference between them: 5, 6, 4, 3, 16, 1, 10, 1. And the TIC to EBITDA will always be higher than the EV to EBITDA. Why is that? Well, it's because enterprise value is reducing, the numerator is reduced by the amount of the cash on the balance sheet, whereas the second one is not reduced by it. So if we decrease the numerator in any ratio, what will happen to the ratio? It'll get smaller. So TIC has the bigger numerator because it includes all the cash. So if we look at all of them, by the way, we can see they're all significantly higher than the enterprise value to EBITDA. Well, not significantly, but they're higher. So it gives us an idea of how much cash we're talking about. Look at B. 16.1 to 10.4. So right away we can see just the difference between these. B's sitting on some cash. Whereas we look at D, 6.7 to 6. D's not as cash heavy. 10.6 to 8.5 and 5.6 to 4.3. It kind of looks like A and C are kind of equal in the amount of cash they're sitting on, but B looks very cash heavy. All right, let's talk about the difference in these. Now, you can't just look at these. Let's just look at enterprise value to EBITDA. You can't just say, well, B's super expensive and A is really cheap on an enterprise value to EBITDA basis. Because here's why. But it might be justified. Let's have a look at what drives EBITDA. Remember, it's positively related to growth in free cash flow to the firm. So let's look at our profit margin and let's look at our quarterly growth. A has got negative quarterly growth. And if you look at its net profit margin, it's the lowest of all of them. So it appears, based on these two numbers here, or these two measures, it appears that it would make sense for A to probably carry a lower value of enterprise value to EBITDA because it does have the lowest growth of the four, and its quarterly revenue growth is negative. We look over at B. B has got a much better margin, but look at its growth, 28%. Look at the difference in the enterprise value, 4.3 all the way to 10.4. We look over at C. C's got 12.45, but a more modest 5.7% growth. So we can see that G is really the big one, and that makes sense. Because if you can continue to grow G at that rate, those numbers end up snowballing very big. That makes a lot of sense. We look over at D, almost double the profit margin of A. Negative 21% quarterly revenue growth, negative 23. So they're almost tied there. But D has much higher margins. So it's not that much higher, 4.3 to 6. We get the big jumps at the 8.5 and 10.4. But when you're looking at all of these, they appear to be justified. So just because they trade at different enterprise value to EBITDA ratios doesn't mean we can say that they're relatively undervalued, overvalued, fairly valued. We have to look at it in light of what's being captured by that measure. And what's being captured is G, free cash flow to the firm. There's our G here, free cash flow to the firm. Return on invested capital, of course, negatively weighted to weighted average cost of capital. So we would combine this with other measures, like we've just looked at here, to determine if something is amiss. Now, if we looked at A and we saw 9% profit margin and 7% quarterly growth, then at that point you scratch your head and you go, well, now that's interesting. It appears to be undervalued. It is now worthy of some extra attention from me. But at this point, if I were doing a quick pass, at this point I would say everything looks like it's in place. I don't see anything jumping out at me. Let me take another approach. Okay, let's look at some other enterprise value multiples. We can have enterprise value to free cash flow to the firm, EV to EBITDA, and the R is just adding back rent expense. And this is to compare companies that own their own properties with those that rent their properties. So if you add back the rent expense, they become comparable. EBITDA, this is where amortization is the major non-cash charge as opposed to depreciation. And then EBIT for companies where depreciation or amortization is simply just not a major item. You'll notice that all of them, though, add back interest. The next one is enterprise value to sales. Not as popular as enterprise value to EBITDA, but it does correct the price to sales issue. If we look at price to sales, not all sales belong to a company's equity investor. And it's going to show up in the net income depending on how much debt a company has, because interest has to be paid. So price to sales is taking a company-wide measure and looking at a multiple in terms of only an equity price, whereas enterprise value to sales does it right. It says, look, enterprise value is everyone, all the providers of capital. Sales go to all the providers of capital. So just to show you how not comparable they are, take Company A and Company B. Company A has debt equity ratio of 80-20 and B has 20-80. So huge difference in financial leverage for Company A. So the price to sales, if we're using price to sales on A, is not going to be comparable to price to sales on B, since price is an after-tax, after-interest measure of the cash flow to the firm, because it's P captures cash flow to equity. Well, you pay off the debt providers first. So some of the sales that we're making goes to pay back principal and interest. That's simply not available to the equity investor, yet we're using in the numerator a measure of the value of equity as opposed to a measure of the value of all the sources of capital. So enterprise value to sales sort of corrects it. Now, you don't have to find sales per share at this point. You're just using top line sales number. Well, the net sales at that point, but top line revenue. Okay, let's look at some cross-border valuation issues. We talked about one earlier when we talked about the ability of a firm to pass through inflation. And when we're comparing two companies in two different countries that are facing different inflationary regimes, you sort of have to take that into consideration. Let's look at these differences that we have here. LOSO is asking us to explain differences, and I've got 4 of them down here: accounting methods, tax regimes, economic differences, and cultural differences. Accounting methods is the most obvious, GAAP versus IFRS. Even with convergence, the need for reconciliation will not disappear. Now, I don't know if you're aware of this or not, so I'm going to tell you. When you are doing level 2 in the exam, the assumption is IFRS. All questions are the baseline for questions is IFRS unless GAAP is specifically pointed to. unless the question specifically says to consider this is under GAAP, what would happen. Any accounting decision you look at in level 2, you assume it's IFRS. That's the home plate. That's the baseline. GAAP is the one that we visit. It's not that GAAP is our baseline and we want to bring IFRS to GAAP. IFRS is our baseline and we need to bring GAAP to IFRS. Just so that you get that you really want to pay attention to IFRS. GAAP will be the outlier. Different tax regimes, and different tax regimes affect the cost of debt versus the cost of equity and the level of financial leverage. So if you take a country that has higher corporate tax rates than another one, and if I were domiciled in the country with the higher tax rate, I suddenly have an even lower cost of debt because it's an after-tax cost. So if I can float a bond issue at 3% in the high tax regime, and float a bond at 3% in the low tax regime, I'm more likely to use debt when corporate taxes are higher than I am to use preferred or equity to finance growth and operations, simply because it lowers my cost of capital. So the level of financial leverage will be greater. So if we look at Europe versus North America, for example, most European companies have a higher debt equity ratio than North American companies because they face higher tax regimes. So the tax regime will affect the financial leverage that's being used, which means you're more likely to compare on cross-border comparisons at an enterprise level as opposed to a firm level. Economic differences, different stages of the business cycle. Labor laws, union strength. There are different labor laws in say, Germany is a good example. Germany versus the U.S. You want to get rid of employees in the U.S., it's quite easy to do. You're gone. You want to get rid of employees in Germany, that's not so easy. It's not so easy. So the turnover in employment in Germany is much lower than it is in the U.S. because of much, much tougher labor laws. So that going into recessions, companies in Germany don't scale down employment at the same rate that companies in the U.S. can scale down employment. And you got to look at union strength because, honestly, a union every 3 years can shut you down. They have that economic weapon that's called a strike. And, I think it's time that the unions are stripped of that right, because it is an economic weapon. It causes destruction far beyond the company that they represent. It's not just the union and their members that go out on strike. It affects, since we have global supply chains now, when a union goes on strike, it affects everyone. For instance, when CP Rail in Canada went on strike several years ago, the tax hit to the rest of the taxpayers was about $400 million. So all of the taxpayers of Canada had to foot the bill for the $400 million loss because that's not coming back. Well, we got to pay for that. We got to pay for that. When they go on strike, I spent a lot of time in Windsor when the auto companies there go on strike. They shut down restaurants, they shut down small businesses because they can no longer survive. They shut down all of the factories and plants that feeds a product to them because they can no longer survive. People lose jobs, lives get destroyed. A strike is the sacrifice of the many for the benefit of the few. It's an economic weapon. We should treat it as a crime and put these people in jail next time. Whenever these union organizers decide that it's time to strike, they should have to go to jail for the length of the strike, prison, not jail, prison, and the union should have to make good for all economic losses beyond beyond just their lost wages. They must make good for all economic losses. And then I can agree with unions. Anyways, there's my tirade about unions. So you know a couple of things about me already. The guy hates technical analysis and don't even talk to him about unions. Yeah. Forex effects, currency effects across country. You got to worry about that now. Cultural differences. You wouldn't think that you have to think of cultural differences, right? But you do, and here's why. Because there are different attitudes towards risk, different attitudes towards debt, different attitudes to how employees are treated. For the longest time in Japan, not so much anymore, But for the longest time, through the 80s and the 90s in Japan, lifetime employment. They had a very paternalistic attitude towards their employees in those organizations, and they didn't scale down in bad times. They just said, we're a family, we live through it. They don't really do that too much anymore. It's hard to compete in a modern world when you're playing good guy and no one else is. You're not going to win. You're not going to win. So when you're doing cross-border valuation, it's kind of in order of importance, your accounting methods, tax regimes, economic differences, but you do have to pay attention to those cultural differences. Okay, so our next topic here, learning objective P. I just came off a union tirade saying I don't like unions or technical analysis, and bang, here's some technical analysis. Momentum valuation indicators. Number one, earnings surprise, also called unexpected earnings. And unexpected earnings, UT, for whatever time period, is simply just the EPS, the actual EPS, minus whatever was forecasted, whatever the consensus estimate is. So if the actual was $1.10, the consensus was $1, you have an unexpected earnings component of 10 cents. For the expectation, you must also consider the range in estimates. For example, have a look at two ranges here. Let's say that there are 30 analysts, each providing an estimate for EPS for the next quarter. One of them, the range is between 87 and 93. The other, the range is between 62 cents and $1.21. And let's say that you have a 10-cent surprise. On which one would it be more critical? A 10-cent surprise here, if you look at the average of all of this, you might have an average of 95 cents. So a 10-cent, if it came in instead of 95, came in at $1.05, well, there are still some who are guessing higher. But here, you got an average of 90 cents, it comes in 10 cents higher. Nobody was that high. So the tighter the range, the surprises here become more meaningful. So it's not enough to look at just the surprise. It's, well, how surprising is it given how dispersed the estimates were? So what we would do is we would take what we have here, our earnings surprise, and we divide it by the standard deviation of the dispersion of the estimates. So that is called a scaled unexpected earnings, which is, of course, our earnings surprise in the numerator divided by the standard deviation of the analyst's earnings forecasts. Next one, the standardized unexpected earnings. And again, this is the same thing in the numerator. It's just your unexpected earnings, but rather than dividing it by the standard deviation of the analyst's estimates, you're dividing it by the standard deviation of the past earnings surprises. So it's the standard deviation of the past earnings surprises. So you can see in the brackets here you have exactly what you have in the numerator, except it's all the past earnings surprises, maybe 20 quarters. Let's say just over the past 20 quarters. Then you'd look at the standard deviation of what all those surprises were based on this surprise. So if you have a 2-cent surprise up here, but the standard deviation was normally 4 cents, well, then that's not so great anymore. But if it were 10 cents up here and the standard deviation were 2 cents, suddenly that's a big surprise, right? That's called the standardized unexpected earnings. You're standardizing the unexpected earnings by its own standard deviation of past earnings surprises. The third one's called a relative strength indicator. And it compares a stock's performance during a particular period with its own past performance or some group of stocks. So let me give you an example of a popular way to create one of these and track one. Let's say you're judging a stock against the S&P 500. The S&P 500 has got a price of $2,085, and the price of the stock is $26.50. So if you divide $26.50 by $20.85, you get 0.012709. Let's say that's your starting point. So what you want to do is you want to divide that by itself. And if you divide it by itself, what will you get? You'll get 1. Now, stick with me. Watch what I'm going to do with this. You divide it by itself, and then you put this number over to the side on the side of your desk, and you say, I'll bring that in a little later on. Let's say after a certain amount of time, whatever period you're looking at, because you'll look at this period by period by period because you're looking for relative strength, right? And let's say that the S&P 500 is now 2163, the price is 2972, the index went up, the price went up. So what we can do here is you take our 2972 and we'll divide it by the current index, which is 2163, and we'll get 0.013740. Now you'll divide that by this factor you used to get it to equal 1. So we'll have 0.01374 divided by 0.012709 equals, we get 1.0811. What is this telling us? This is telling us that that we have relative strength of 8.11%. So in other words, even though S&P went up, the price of our stock went up even more on a percentage basis. It outperformed by 8.11%. And that's what relative strength will do, is on a day-by-day basis, it will track the relative strength of whatever it is you want to track. So if it's 1, it's the same. If it's less than 1, it has the index has more strength, and if it's greater than 1, it has strength. Now, the second part of this relative strength is from day to day, you want to have a look at the increase. This is 108.11. Let's say it was 1.0693, etc. And you want to look at the percentage change from day to day, and you're looking for this relative strength to start really increasing. And then you have something there. I don't know. There it is. That's how it's measured. I'm skeptical whenever you start applying all of this data snooping and digging around to things. I get really skeptical. Here's the deal on this thing. It is notorious for data snooping. Because if you look at 50 stocks that you have found that are strong, several of them will display this pattern. But is that pattern purely because there's something unique about that? Or would, out of a group of 50, 3 or 4 display that pattern no matter what? In other words, are you really finding something, or are you just finding exactly what you're looking for? I'm always suspicious of these sorts of methods. The data as far as does this stuff work, by the way, there's been research on does this actually work? And some studies say, yeah, it worked here, and other studies say we can't get it to work at all. Again, if you try something that doesn't work 50 times, just out of pure chance, it'll probably work 4 or 5 times. For instance, if I jump on one leg long enough, a plane in the world will crash. Yes, I caused it. If I jump on one leg long enough, planes will crash. That doesn't mean anything, though, but I can say, look, I'm going to publish this paper now. I jumped on one leg and a plane crashed. Well, if everyone jumps on one leg long enough, planes are going to crash. So this is sort of my thinking about stuff like this is without any real theory backing it, without anything driving it. For instance, if the stock is outperforming the index, don't tell me that the price is exceeding the price of the index. I want to know the catalyst. You should have known the catalyst, not just the result. Give me the catalyst. If there's no catalyst there, all you found was an anomaly that'll probably disappear. Okay, so averaging multiples. This is sort of important to know, and how multiples are averaged. If you give somebody 10 PEs and you say, what's the average? The most common way that it's arrived at is an arithmetic mean, which is wrong. An arithmetic mean is just you take whatever observations you have. If you have 10 observations, you add them up, you divide by 10. Let's move on to something called a harmonic mean. And the harmonic mean is a little bit different. What you do is it's instead of the average over n, you take the reciprocal. It's n over, and you're not taking x anymore. It's the reciprocal of that as well. So it is the reciprocal of the arithmetic mean of the reciprocals. So you just flip this upside down and make sure you take the reciprocal of the x's. So you're summing the 1 over the x's over n. This inherently gives less weight to higher PEs. So let's say that you're looking at 10 stocks and one has a EPS of a penny, selling for $9 has a PE of 900. Well, look what happens when you take the reciprocal. 1 over 900 totally washes out the effect of that outlier. So it's just really not so much of an outlier anymore. Well, if you go the other way, and let's say a stock is extremely undervalued and has a very low PE. Well, the lower and lower that PE gets, the higher the weight it gets. Well, it's bounded below by 0, which means it doesn't exist anymore. But a stock with a PE of 1 has got a serious problem. So everyone should be looking at that. Why is it selling for 1 times earnings? All I got to do is buy it, wait a year, I'm good. So it's not that on the downside it's too much of a problem. On the upside it is. So it gives less weight to higher PEs and more weight to lower PEs. The harmonic mean will always be less than the arithmetic mean. Now, if you go one step further on the harmonic mean and you use a weighted harmonic mean, which means you're weighting it, the WIs are portfolio weights, and all the portfolio weights sum to 1, you'll get the most accurate average of the multiple, of whatever multiple you're using. Okay, so let's look at an example here. We'll look at just a really simple example, a 2-stock portfolio, security A and B. Here's the market cap in dollars of each one and the percentage of the overall portfolio that they represent. Earnings for company A, $71.50. It's $715, $71.50. So it's got a PE of 10. Here we have $29.50 on 585. That gives it a PE of 20. So if we're trying to find an average PE for the portfolio, we wouldn't just say 20 plus 10. If we were doing an arithmetic mean down here, that's exactly what we would do. We'd say it's 10 plus 20 over 2 equals 15. That would be sort of the wrong way to do it. How we would do it without using a harmonic mean or a weighted harmonic mean is just quite simply is you'd say, well, it's price divided by earnings. Well, what's our price? Our price is 715 plus 585. And what's our earnings? It's 71.50 plus 29.50. And if you add these two up, you'll get 1,300 over denominator is 110.75 will give us 12.9. That is the true portfolio PE, because it's, again, price times earning. What's the price of the whole thing? You just add it up. What's the earnings of the whole thing? There you go. Notice the arithmetic mean gave us 15 as opposed to 12.9. So we know that that can't be right. Let's move on to a harmonic mean. A harmonic mean is n over. So we just flip this, and in our numerator we would flip again. So our first flip puts the 2 on top, and our 10 plus 20 is the denominator, but we have to flip those, so it's 1 over 10 plus 1 over 20, which will give us 2 over 3 over 20. Our denominator is 3 over 20, which will give us 13.33. Again, still not 12.9, but the harmonic mean gets us closer to the actual average or portfolio mean, and it's a lot better than the arithmetic mean. In fact, the harmonic mean will always be lower than the arithmetic mean. Let's do a weighted harmonic mean now. A weighted harmonic mean, the numerator is just 1 over, and instead of 1 over 10 or 1 over 20, it is the weighting. So it's not a full 1. Our weighting here is 0.55. 0.55 over 10. And here we would have 0.45 over 20, which will give us 1 over 1.55 over 20, right? And which will give us 12.90. 12.90. So to get an average PE for a group of stocks, we would be taking a weighted harmonic mean to get there. But to take a weighted harmonic mean, we must at least know what a harmonic mean is. And to use a harmonic mean, we must know why we wouldn't use an arithmetic mean. So it's a long way to go from take an average to you really should be using the weighted harmonic mean. Well, when we see weighted harmonic mean, it's like, what's going on here? I don't get this. But there, we've stepped through it step by step so we can get to the conclusion. You get it. Now, when you're reading research or reading another analyst and they talk about the peer group that they've used and that they've used a weighted harmonic mean to arrive at an average PE of something, you know exactly what they're talking about, and you can say, yep, that's the right way to do it. And that will wrap us up for this learning objective. Now there's one more, for this reading altogether, there's one more learning objective left, but we've done it all the way through. which is to evaluate whether a stock is overvalued, fairly valued, or undervalued based on comparisons of multiples. We've done that all the way through, so there's really no need to do it again. This wraps up this extremely long reading. It was the longest reading so far. The next two readings go rather quickly.